This meeting is being recorded.
Hello, everybody. Good morning. Hello, Hannah. Hi, Caitlin. Hi, Luke. Hi, Maria. Hi, Isla. Welcome all to the chat. Nice to meet you all. So I'm Gemma. I'm going to be taking you for a couple of your SEMA F1 classes, specifically the first day and the second day, so the first 2 days of the course. How today is going to run, the first day, is I'm going to start off with a little bit of admin, what to expect from the course, what to expect from the exam, what we're going to do on each day, that kind of stuff, sources of support, things you should have, resources, that kind of thing. And then we're going to get diving straight in with the content. So, first things first, I've popped on my contact details on the first screen. I did send you an email last week, so you should already have my email address. But for any kind of late enrolment students, it's on the screen there. If you need anything, you can absolutely give me a message. And in terms of a little bit about me, quick introduction. I am an ICAW chartered accountant, so I qualified in the ACA qualification. I qualified at PwC, so I worked in audit and assurance. And then I came to Kaplan about 3 years ago. And the types of things I teach at Kaplan, I teach right across the syllabuses. So I teach ACA, I teach ACCA, I teach AAT, and I also teach SEMA. But the papers that I tend to teach are mainly kind of the financial reporting, audit and assurance style ones, the accounting papers, just because of my background. So in terms of this exam and how the next couple of lessons are going to run, they're all online. You can ask any questions at any time. So if anybody hasn't done the online classes before, you can use the chat panel, that's absolutely fine. Or if you wanted to unmute yourselves to ask a question, that's fine as well, whichever you prefer. Hopefully you have received your Kaplan integrated workbook. Is there anybody who hasn't received their Kaplan integrated workbook? Sometimes if you're a late enroller, they might still be in the post. But hopefully we've all received it. If not, and you just kind of don't want to say, that's fine. You can access your integrated workbook on My Kaplan. So if you go onto My Kaplan, click on content, your materials, your integrated workbook is on there. So if you haven't got it physically, go onto that link now, onto My Kaplan, to get it virtually, because you're going to need that for today. So you've got your integrated workbooks. That's what we're going to be working through today. We'll have a look at a couple of chapters and we'll work through those along the course. There's other things on My Kaplan as well. So there's things like progress tests, consolidation tests. When you do see those, please don't do them until we tell you to do so. They're at set points in the course, and if you do them early, you just haven't learned the content to do them yet. So I'm just going to say there, don't do, because you'll be told when to do them. There is a couple of mock tests as well. Again, rules are kind of don't do them till you've learned all the syllabus, otherwise you're not really going to know what's going on. One of our British values, mutual respect. So if you aren't speaking, please do keep your microphones on mute just to eliminate background noise. If you need to nip out for any reason, we're all kind of working adults here, so if you need to take a work call or pick your kids up from school or whatever, that's fine. You don't need to let me know, but please do make sure that you catch up on anything that you miss. The sessions are recorded, so I'll show you in just a second where you can access the recordings if you miss anything. And then probably the most important part of the day, break times. So break will always aim for lunch at 1 till 2. So if you want to make any plans for lunch or get something in the oven, then 1 till 2 is when we'll break for that. We'll take a couple of other short breaks throughout the day. So we'll tend to take a short break around 10:45-ish till about 11, give or take. And then depending on how we're doing, we'll probably take about a 12 o'clock break just for 5 minutes or so, just to stretch our legs. And then in the afternoon, we'll take a little 10-15 minute break around the 3, 3:15 mark. We won't finish any later than 4:30, so that's the cut-off time. But if we finish early, then I'll let you go early, but we'll see how we go. But it won't be any later than 4:30. All right, so in terms of the course structure and where this exam fits into your wider SEMA journey, you are sitting at the moment at this operational level, and F1 sits in the kind of financial pillar. Whatever you learn at F1, when you've finished it, don't bin your notes, don't get rid of them, because A, you might need them for the case study, which is kind of a synoptic case study, but you'll also need them for F2, because F2, you'll do everything you've done at F1, but build on it a little bit more, and then the trajectory continues, and then you'll go all the way up to F3 if that's how far you want to take it. So you'll keep building on your financial knowledge through the F kind of column in this. There is, as I've just mentioned, 5 online classes. The first 4 classes are tuition. The last class is a revision class, so lots of question practice in there. I'm going to skip through most of this until we get to the bottom, which is the exam. What exactly are you setting yourselves up for? So the exam is 60 questions. Now, they are objective style questions, so think anything that a computer can mark. So that's things like entering numbers into boxes, ticking those that apply, selecting which one is correct or which 2 of 5 are the most appropriate. They're all kind of multiple choice based or numbers in boxes questions. It's not going to be asking you to write constructed responses, so not typing out your own answers. It's anything that a computer can mark. Now, you usually have around 90 seconds per question, and that's because the exam is an hour and a half. Now, when you get closer towards the exam, when you've done a bit of revision and you've done all the syllabus, that doesn't really tend to be time pressured. It's quite a nice kind of pace. It shouldn't feel like you're having to rush through it. But we'll get to that point by day 5 when we do lots of revision questions in day 5, and they'll be kind of done to time to give you a feel for it. Mentioned just here that objective test questions doesn't just mean pick 1 from 4. It could be things like drag and drop, answers into boxes, choose those that apply, state those that apply. And this one is really common in F1, entering answers into the box, because there is a little bit of numbers, there is a little bit of calculations, because it is got some financial accounting in here. So it's a really popular kind of question choice, that one. In terms of the pass mark, we say aim for 70%. It is a scale score, so they kind of find the top echelon and pass them automatically, and then find the cut-off points between the pass and fail. But we usually say if you're scoring 70% and above on mock exams or online assessments, then you'll definitely be in the green zone. Now, I know it seems really, really early, but if you have a specific date that's been given to you by your employer, or you have a specific goal in mind of when you would like to sit this exam, then I would recommend booking it sooner rather than later, just because some of the exam centres get quite booked up. So if you're in a kind of busy area, a city, somewhere like Manchester, London, Birmingham, then the ones in the city, the town centres, tend to get quite busy and booked up. So if you know when you want to do it, if you know where you want to do it, then I'd book it sooner rather than later. Okay, any questions on the exam so far? No? All right, so a couple of things that I just want to flag to you on my Kaplan. I'm just going to share my screen on my version of my Kaplan just to highlight a few bits and bobs here. So on the course homepage, anything that I think is important, I will post in here. So anything such as the annotated notes from today's class will be posted in here. Anything I write on screen, any resources I give you, I will pop in this course announcements page. In the content page, you've got a couple of useful bits. One of the biggest things is being the recordings. So if on the content page you click on course calendar, then you need to toggle over to full schedule, and then here you can see all of the classes that you've got coming up, and the recordings are usually available about 24 to 48 hours after the session. So if you click, for example, on the Thursday one in a couple of days' time, then underneath where the online session joining instructions are will be a recording link. And if you click on that, then it will take you to this recorded class. So that's where you can access the recordings. You can listen to them in kind of ×2 speed, ×1.5 speed. But I do tend to talk quite quickly, so I'm not sure if that would work, but you can give it a go. Also on the Your Materials tab, this is where I mentioned you can access things like your Kaplan integrated workbook. So if you don't have the physical copy, then use that link today. You've also got some revision cards, but I wouldn't worry about that till a bit nearer the time. Other bits that I just want to flag is this study modules tab. So a study module, sometimes some of the chapters are set for homework. I'm going to flag which ones they are in just a moment. There's not much. I think it's just like one chapter in this course, but 1 or 2 chapters. But whenever I do set something for homework, you can have a go at doing the study module alongside the chapter that's been set for home study. A study module exists for every single chapter. So you can see chapter 1, 2, 3, you click on it, and basically it will be a mini guided lesson. It will take you through little videos, little exercises that align with your integrated workbook to help you as an extra resource. Now, again, if you don't feel very comfortable on something we've done today or any of the other classes, you can also use the study module to just supplement your learning. So if today you weren't really very happy on chapter 1, you could look at the study module for that as well if you wanted to. Okay, so other bits on my Kaplan is if you go into this button here, the Contact a Tutor button, then you can email a tutor, you can chat with a tutor, you can request a call back from a tutor. Now, this is a really useful resource because what that does is links you through to something called academic support. It's not me, it's another team who are basically employed to answer your questions. So if maybe you were emailing or wanted to know a question over a weekend, bank holiday, evenings, times that I don't tend to teach, then you can email and chat with a tutor from academic support, and they're just a little bit quicker for kind of out of hours stuff. And they're also working in hours as well. One last thing is just on the help and support pages. If you click on help and support, if anybody has any problems with the course, such as clashes with bookings, not receiving materials, problems with booking your exams, any kind of admin support that you need, then we've got the Kaplan Student Services contact details here. So there's a phone number, there's an email, there's their opening hours there too. That academic support team that I just mentioned to you about contacting a tutor, their opening hours are available on the help and support page too. You can see they work quite a lot of hours, 8 o'clock in the morning till 8 o'clock at night, including weekends and bank holidays. And then just at the bottom, you've got some extra emails there for safeguarding if you have any wellbeing concerns, and additional learning support. So if you need any extra materials in different colours, that kind of stuff, give those guys an email, they'll help you out. Okay, so a bit of a whistle-stop tour of my Kaplan there. If anyone does have any questions or issues on that, just give me a message. So today, what are we going to do? Let's have a look at the contents. So we are going to start off with the tax section of the F1 exam. Now, I know a lot of you, some may work in tax, some may not work in tax. Most people don't particularly like tax, but the tax in the CIMA exam isn't particularly difficult. It's quite nice, I quite like it. It's a nice tidy little section. And we're going to cover off chapter 1, which is the features of tax and the regulatory environment. We're going to do chapter 2, which is about income tax and capital gains tax, and then a little bit on international taxation as well. So the tax in your F1 exam makes up around 20% of the syllabus. So quite a nice tidy chunk there. Then today, we're also going to look at chapter 4, which is actually part of your homework for today. Chapter 5, which is on ethics, and chapter 6 on corporate governance. So all of that is going to be day 1. Now, chapters 4, 5 and 6, I actually tend to call these the easy win chapters because they're not calculations. They're just kind of the theory behind accounting, a couple of concepts, and they're worth 10%, but they're quite a nice 10% to get. Things like ethics and corporate governance, which is like rules-based system versus principle-based approaches. It's not tricky stuff, so it's quite a nice 10% in the bag with those. Now, the exam for F1 is a pretty mixed exam. You've got a little bit on tax, which we're going to box off today. You've got a little bit on accounting, which is the biggest chunk of the syllabus. And then you've got a bit on management accounting as well, like working capital. So after today, the next session, day 2, we're going to shift towards more accounting elements. So we'll look at chapter 7, the conceptual framework. We'll look at an introduction to single entity accounts. We'll look at non-current assets. We'll look at assets held for sale and discontinued operations. And all of that will be covered off in day 2. And then if we carry on with the kind of accounting elements, you're going to look at leases, inventory and events after the reporting period, cash flows in day 3. Now, I've kept all of those in a green highlighter because all of them can be chunked together to form the accounting part of the course. And the accounting part is the biggest section. It's worth 45% of your exam. So you've got 20% on tax, 10% on concepts and theory, and 45% on accounting. Then the last little part at the bottom is on your working capital, a bit more management accounting stuff. So you've got chapter 4 about finance and investments, chapter 15 on working capital, chapter 16 on receivables and payables, chapter 17 on inventory control, and chapter 18 on cash control. And that working capital section, you'll cover all of that off in day 4, and that will represent 25% of your exam. So you can see it's a pretty mixed bag. You've got tax, accounting, and a bit of working capital in there as well. Now, you probably noticed that the course is actually 5 days, and that's because on day 5, that will be a revision day. You'll do lots and lots of questions from the exam kits and from something called exam prep tests as well on my Kaplan. I've just popped on below, I'll upload this onto my Kaplan, but just those different elements, the accounting, the tax, the working capital and the theory, and how much each of those elements is worth, the weighting. But I've already done that with you, so I won't go through that again. Okay, so any questions on the course? Because we're going to get stuck into today's taxation in a moment. No? All right then, so some of you are probably apprentices. So I've just popped on the page here the Achieving Success slides, which basically covers off your knowledge, skills and behaviours. So they are today, knowledge, skills and behaviours for chapter 1 and 2, and then you've got chapter 3, 4, 5 and 6, knowledge, skills and behaviours as well. Now these are usable to do your learner journals. If you are an apprentice, you'll probably know what these are. If you're not an apprentice, you can completely ignore this. Don't worry about this. I'll pop it all onto my Kaplan though, so you don't have to take screenshots of it now. I'll put it onto my Kaplan. A question in the chat, which chapters are for homework? Yeah, so I'll go through homework at the end of today. But for today, the only chapter that will be homework will be chapter 4 today. But I'll go through the homework with you at the end of today, so don't worry. All right then, so let's make a start then on chapter 1. So if you could turn to chapter 1 for me. And as I've just mentioned, this morning and most of this afternoon is going to be looking at this first 25% of the exam, or 20% of the exam, which is all about taxation. So we're going to look at chapter 1, which is very wordy. It's learning about the concepts about tax and the computations to calculate tax. And then in chapter 2, it's a lot more fun because we get to get our calculators out and actually calculate and do the taxation. So bear with chapter 1 for now. It's a bit wordy. There's a lot of me talking, but chapter 2 will be more practical. So we're going to look in chapter 1 about types of tax, indirect tax and direct taxes and the difference between them. We're going to look at things like where do tax rules come from, what are the rules around keeping records. We're going to look at tax authorities and a difference between tax evasion and tax avoidance. Just out of interest to begin with though, does anybody know the difference between tax evasion and tax avoidance? Anybody come across those terms before? So got Jasper, tax evasion is illegal. Yeah, absolutely. It is illegal. It is not allowed. You would be committing a crime. Yeah, and absolutely, Maria, Hannah, Jasper, tax avoidance is legal. It may be frowned upon. I like that. We'll come back to that point in a little while. It may be something that's frowned upon, or it may just be seen as effective tax planning. Could be okay, but most of the time it's seen as kind of offshore tax havens and being a little bit naughty. Okay, so let's have a scroll down to the first introduction page here. Now, what we've been told is in the introduction in taxation, what is the purpose of tax? Now, governments collect and use tax to pay for things such as public services. Now, public services are goods provided by the state, so things like hospitals, school, policing, retirement pensions, social benefits. Sometimes the government use it to pay off borrowings, but that's the purpose of them collecting this taxation. Now, they have some features of what good tax should be. Now, I know it's a bit controversial. Nobody thinks tax is ever good, but in the government's eyes, a good tax system has the following aims. It should be fair. Now, by fair, that means it should be based on their ability to pay. So it should be what we would call equitable. Now, in the UK, we actually have a fair tax system, and it is based on people's ability to pay, because we have something in the UK called progressive tax. And what progressive tax means is the more you earn, the higher percentage of tax you have to pay. So if you earn up to about £37,500, you'll pay 20% taxation. If you earn above that, you'll pay 40% taxation. And then if you're a really high income earner, kind of in the 125k plus region, you'll be paying 45% taxation. So the government think that's fair because if you earn more, you should pay more tax. And yeah, absolutely, it's all about thresholds there. So setting certain thresholds in the UK. Now, a good tax system should also be absolute, and that means it's quite certain, it's not arbitrary. So in other words, it's very rules-based. It's very black and white. It's understandable. People know what is correct and what the rate should be. It should be convenient in that it's easy to pay. And again, we can think about the UK. The UK has a very convenient tax system because we have something called pay as you earn. So sometimes that's abbreviated to PAYE. Now, what that means is when I work at Kaplan, I get my salary that I'm contracted to, but actually the money I receive in my bank account at the end of every month isn't the salary that's on my contracts. And that's because what Kaplan do automatically is they will deduct my wages for the income tax and the national insurance that I owe, and they'll pay it over to HMRC, the government, on my behalf. So that's an example of my tax is being paid as and when I earn the income. And that's a convenient, easy to pay tax system because I don't have to do anything. I just receive the net amount in my bank and Kaplan have already paid the government for me what I owe. It's very easy, it's very convenient. And that links to kind of the last point as well. It needs to be efficient, a tax system. So it needs to be quite low collection costs, very cheap for the government to collect. And that's, again, exactly what we have in the UK because the government has no costs for getting the tax from me. And that's because it's my employer who bears the cost. It's my employer who has to have those kind of payroll experts who calculate how much I owe and send it over to HMRC. So all Kaplan are really doing is acting as a debt collector for HMRC on my behalf. So it's very, very cheap for HMRC, the government, to collect tax from me because they don't do anything. Kaplan do it all for them. So we can kind of bring this into 3 ideas of what is a good tax policy. And sometimes this is referred to as a 3 E's model. It should be equity, efficiency, and have good economic effects. So equity, we've already talked about that in the kind of points above. It should be fairly levied. So it should be equitable, it should be fair based on their ability to pay. It should be efficient, which means it's cheap and easy to collect, like we spoke about with the PAYE system. And it should have good economic effects in that it's based on people's ability to pay. So economic effects and equity are quite similar there. So typical question in the exam, maybe you get a question saying, what are the 3 characteristics of a good tax system? And one of the answers says equity, efficiency, and economic effects. So you tick that one out of maybe a couple of options. Okay, so we know what good tax is. We know why tax is collected. On the next page, we've now got the difference between 2 types of taxation. We've got something called direct tax and something called indirect tax. Now, a direct tax, that is something which is paid by those who generate the funds. So by that, what I mean is if I draw a little old me over here, I earn an income. I'm earning some funds. And because I am earning money, I am directly responsible to then pay over to HMRC income tax on that. So I earn money, I therefore have to pay tax on it. So it's a direct relationship. It's paid by those who generate the funds. It's paid by me because I've earned an income. Now, they've given us some examples. They said it's paid directly to the government by the person or entity liable for them. It could be things like tax on personal income, such as your salaries. So in other words, income tax is a direct tax. It could also be tax on business profits or tax on disposal of chargeable assets. So if it's tax on business profits, anyone know what we would call that? If a business makes money and has to pay tax, what is that tax called? Yeah, absolutely, Erica, it's corporation tax. And then they've also said as well, disposal of chargeable assets. Any guesses on that one? What would that be if there is a tax on the disposal of a chargeable asset? Yep, so Luke's got that there with capital gains tax. Yeah, Victoria, Hannah as well. Erica, VAT, no, it wouldn't be VAT. We'll come on to VAT in a second. VAT is an indirect tax. So the one I'm after there is a capital gains tax. And that's because it's the same kind of idea here. If a business disposes of an asset, they've made a profit on that asset, they are therefore directly responsible to pay tax on that because they've generated some funds, they've generated some money from selling the asset, so they have to pay tax. The same things with business profits. You've generated funds, so you're going to have to pay tax on those funds that you've generated. Now, that's as opposed to indirect taxes, which is just underneath. Now, indirect taxes is actually a tax on goods or services. So I'm just going to draw another kind of stickmen diagram on the side this time, because we've got me again over here. And this time I'm a bit hungry and I want to have a snack. So I'm going to go to Tesco's and I'm going to go and buy myself a chocolate bar. So over here, we'll say we've got myself a chocolate bar from Tesco's. Now, when I do that, I'm going to have to pay some money. Now, maybe Tesco's have charged £1.20 for that chocolate bar. So that means out of my own pocket, I am going to have to pay £1.20. Tesco's, they get to receive £1.20. But the problem is Tesco's don't get to keep all of that money. Instead, what happens is they get to keep £1 of it, and 20% of it they have to pay over to HMRC. And that's because of something called value added tax, VAT. And they have to pay 20%, which would be 20p, in VAT over to HMRC. So what we would say here is that VAT is an indirect tax, because what's happened is me, who went to Tesco's, has paid £1.20. £1 of that was to Tesco's and 20p of that has ended up in HMRC's pocket, but HMRC have received that money indirectly because it's gone through a third party. It's gone through Tesco's. So although it's my pocket that's lighter because of the tax, it's had to go through Tesco's indirectly in order to then receive it with HMRC. 24p, there we go. I don't have a calculator on me, so I'm just giving you a rough idea. But yeah, if it was £1, it'd be 20p, wouldn't it? So let's change it to £1, and then they get to keep 80p and they pay 20% over. There we go. So the point here being, if you look at the difference now, you can see that me paying money directly to HMRC because of income, that is direct relationship, whereas paying VAT is an indirect relationship because it's gone through a third party, it's gone through someone else. Does that make sense, the difference between them? So if we read the definition, what they've said over here is an indirect tax is borne by one party, but collected and paid to the government by another party. So it's borne by one party, it's borne by me, but it's collected and paid by Tesco's to HMRC. And the biggest example that you'll get in your exams is obviously VAT, what we've just discussed there. We're going to come back to VAT in this chapter because there is a couple of examples where we have to calculate VAT and figure out what the values are. But if we go on to the next page, we've got a little bit of a detour first around some definitions. Now, these definitions are maybe nice, quick, easy win questions, a quick multiple choice question in the exam, where it says, what is the best definition of such a term? So I definitely flag this as a learn list. I try and learn these. Now, the first one is called incidence. And incidence is the distribution of the tax burden. Now, they've split it up into two elements. They've split it up into formal and actual incidence. So formal incidence is the person or organisation that has the direct contact with a tax authority, as opposed to actual incidence, who is the person or organisation who actually ends up bearing the cost of the tax. Now, these are pretty fancy terminology here, but if we just link it back to my stickman figure on the previous page, I'm going to label these two terms. It makes it a bit easier to understand. So if I go back here, when I got hungry and nipped to Tesco's and got my chocolate bar, me, the customer, I would be the one to have actual incidence. And the way I remember it is it's because it's my pocket that is actually lighter by money. My pocket is lighter because I've had to pay this tax or this sales price over to HMRC, as opposed to Tesco's, who would be the one to have formal incidence because they are the ones who have the formal communication with HMRC. So I'm the one who's actually paying the tax. It's my pocket that's lighter. I've bared the burden, but it's actually Tesco's who had the formal communication. So that's the difference between actual and formal incidence. And a common exam question is to identify which party has formal incidence and which party has the actual incidence. Okay, other definitions is we've got something called the tax base. Now, the tax base is what is it that's subject to taxation? What is the thing that is being taxed? So is it income that's the tax base because it's subject to income tax? Is it the disposal of an asset that's the tax base because it's subject to capital gains tax? So tax base is what is the thing that is subject to tax. We've then got taxable person. I think that one's pretty self-explanatory. That is, who is the person accountable for the tax payment? So is it an individual? Is it a business? Who is that person who needs to pay tax? And then the next definition is the competent jurisdiction. Now, the competent jurisdiction means who is the legal authority who has the right to collect and impose the tax. So in the UK, that would be the competent jurisdiction is the UK government, and they have put in charge of that HMRC. So HMRC is our competent jurisdiction governed by the rules that the UK government lay out. So it's that legal tax authority. They've said here that competent jurisdictions, a taxable person will typically pay tax in their country of residence. And we come back to this idea in chapter 3 with international taxation. But whatever resident you are deemed to be in, whatever country you're deemed to be a resident in, you'll pay tax to that competent jurisdiction. The next term is hypothecation. Now, hypothecation basically just means protection or ring fencing of funds. And by that, I mean that funds isn't tax money, tax income, is collected for a certain purpose. And the tax that's collected is therefore protected and ring fenced and can only be spent on that specific thing. So to give you an example, things like the London congestion charge, that's a form of taxation. So when you drive in London and you pay the congestion charge, any of the income collected from the congestion charge can only be spent on improving the transport and infrastructure in London. It can't be used to go and build a school in Scotland, despite the fact that it might need a school in Scotland. It has to be spent in that area on improving the infrastructure and the transportation network. They've given us a similar one here and said road tax, that is collected and it is ring fenced, it's protected to improve roads, can only be spent on road networks. It can't be spent to build a new hospital in Manchester. It's not allowed. It's protected for a certain purpose. So that's what hypothecation means. And then tax gap. Tax gap is pretty much as it says on the tin. It's the gap or the difference between the tax theoretically collectible and the amount of tax that is actually collected. And the biggest reason why we end up with a difference between what tax is owed and what they actually collect is because of things like tax avoidance and tax evasion. Now, the UK government are constantly trying to minimise this tax gap. And that's because they want to try and collect the money that they're entitled to. So they're constantly putting in place initiatives to try and eliminate this problem and try and get rid of this tax gap. Ways they're trying to do it, there's a couple of real world examples. Quite a long time ago now, probably just over 10 years ago, they introduced something called Making Tax Digital for Business. It was originally announced in the spring budget of 2015, but what that required companies to do is basically create a digital online trail for all of their sales, their expenses, their business profits. All of their accounts basically had to be digitized and uploaded onto the HMRC portal so that they could track how much tax you actually owed them in real time. Another thing that they've done, which is probably a little bit more relevant, is in, so I think it was about 2024, so about 2 years ago now, HMRC made some announcements that they are going to increase communications with selling platforms to try and make sure that anyone who is seen as trading is actually paying tax on that trade. So the companies that they've increased communications with were Airbnb, that was one of them. So anyone who maybe had properties and was renting out a full property, doesn't apply to kind of like just a room in a house share. It was more for if it's a full property or a full flat or a full apartment that you're renting out, then you should be paying tax on that because that's a form of property income. So HMRC have increased communications with Airbnb to try and flag anyone who is trading or using their platforms to rent out properties and earn property income to make sure they're paying tax. They also increased communications with the likes of eBay, Vinted, Depop, and probably most of us guys who maybe sell a couple of old clothes or old bits and bobs on those sales platforms, we wouldn't really be classed as trading. But if there is somebody who is maybe buying in loads of products really cheap from like China or wherever, really cheap manufacturing products, and then selling them online on eBay or Depop or Vinted for a profit and constantly doing that, then they could be seen as trading. And if they are trading, they should be paying tax on any of the profits they make. So they increase communications with those kind of platforms just to try and catch people out and make sure that people who are trading or earning property income are declaring it. So that was in about, I think it was January 2024, they announced that. So just a couple of examples there of ways they're trying to minimise the tax gap. There's loads more, but that's just some that you can have a little read around if you fancied. Okay, any questions so far then on direct tax, indirect tax, or any of those definitions? No? Thanks, Joseph. Okay, let's carry on then and have a look what else we've got to cover in this introductory chapter. So the next one is something called a tax rate structure. Now, I've mentioned this a little bit already, but when a government or when a competent jurisdiction, you know what that is now, when a competent jurisdiction sets the tax in their country, they can choose from different structures for tax. They could have a progressive tax, they could have the opposite, which is a regressive tax, or they could have a proportional tax. Now, a progressive tax is one that's going to increase as your income rises, which is something we have in the UK. So we take an increasing proportion of income as income increases. So if you earn up to just over 37,500, you'll pay 20% tax. After that, you'll pay 40% tax. If you're a high-flying individual, you'll pay 45% tax. So that's progressive. It's progressively increasing as you earn more. Now, the direct opposite of that is a regressive tax at the bottom, because that one takes a decreasing proportion of income as your income rises. So maybe we don't have this in the UK, but let's say in a made-up country, if you sell any property, then you have to pay 10% tax on that capital gain. Whereas if you sell any property up to £10,000, you pay 10%. If you sell any property and earn over that, you pay 5%. So you can see that the percentage is decreasing even though you're earning more. So up to £10,000 profits, you pay 10%. After that, you only pay 5%. That would be regressive. And then the one in the middle is proportional. You can probably guess what that one is. That always takes the same proportion of income, no matter how much the income rises. Are there places that have regressive structures? There probably is. I think some places in Europe have some regressive structures. I think Sweden has one in regards to their capital gains tax. But if you have a look online, there is some countries that do have them. And we've got some examples as in the exam as well. I've got some questions that we're going to do at the end of this chapter, and one of them in there is regressive. So you'll get to see that in just a bit. Now, in terms of sources of tax rules, where do all these tax rules come from? We know that it's the competent jurisdiction who comes up with the tax rules, but where are they stemmed from? So a lot of it comes from legislation that's produced from the government. So in the UK, we have something called the Finance Act. So a lot of the rules that we have for taxation are governed or come from that Finance Act. Sometimes it's based from previous legislation. So sometimes there's things that's been in the news or tax disputes that have happened and they've gone to court. And whatever the outcome of those is, that's helped to shape the future tax rules. Sometimes there's things like tax bulletins. That's basically just kind of notes or guidance on interpretation. And if you go onto HMRC's website, you can find some tax bulletins which explain things like how to account for income tax, capital gains tax, corporation tax. Some tax comes from international bodies such as the European Union. Now, if there is an international body which sets kind of rules that affect multiple nations, then what we would call them is a supranational body. Because whatever they say will affect multiple nations. And then sometimes tax rules come from agreements with different countries, for example, double tax treaties. And I'm not going to go into this too much now because we have a whole chapter on international tax in chapter 3, which we are going to do today. So we'll loop back to that in just a while. So that's the introduction of everything kind of that underpins tax. We're now going to start in the rest of this chapter unpacking the direct taxes and how to calculate them, and then the indirect taxes as well, and specifically what they relate to with the VAT. So in this chapter, the direct taxes, we're going to learn how to calculate them, but we don't really have any questions on it. The questions are going to come in chapter 2. So learn the theory here, we'll get a bit more practical in chapter 2. So in terms of direct tax, we've already learned that that's a tax which is imposed indirectly on a person or an entity. So in other words, we said it is a tax that is paid by those who generate the funds. So if I earn an income, I've generated funds, so I need to pay tax on that. If I've sold a property, I've generated a gain on that, so I'm going to have to pay tax on that. It's paid directly by that person. So examples, capital taxes, as I've just mentioned. So that would be your capital gains tax. And then your tax on trading income, which we would commonly know as our corporation tax. Now, these are the main two in your exam. They're the two that we're going to learn the pro formas for and have a go with the numbers in chapter 2. However, you still need to have a little bit of awareness. You won't need to calculate it, but you will need an awareness of property and wealth taxes. And the biggest example of that in the UK is stamp duty, land tax. So if anybody's bought a property, you may have had a bit of an unexpected tax. I know mine was unexpected when I bought a second property, that you have to pay a stamp duty on that. And it's just a land tax that the government takes. So you don't need to calculate that in your exam, but you do need to know what it is. And we'll come back to that in a moment. Now, corporation tax, they've just said at the bottom, it could be if you make a profit, could be if you make a loss. So we'll look at both of those in this chapter of what happens. So let's take a look at this first one of what happens when you make a profit as a business. What's the corporation tax you need to pay? So over the next page, we've got a whole computation which is going to explain exactly how we work out that corporation tax, which we would call tax on trading income. Now, if we read the first paragraph, it says here, this is trading income is any income, anything you earn from your central business activity. So the tax base, we know that means what's a thing that's taxable. That's going to be the taxable trading profits of the business. Now, we're just going to take a little detour for a second before we do the pro forma and talk about taxable trading profits, because taxable trading profits are not the same thing as your financial accounting profits. Does anybody know why they're not the same? What any differences between taxable trading profit and accounting profit? Anybody seen any at work? Yeah, absolutely. So we've got accounting profit includes depreciation. Yeah, and depreciation is an accounting thing. Absolutely. So one of the things is what you would call disallowable expenses. And this could be something as simple as depreciation. Now, the problem is with depreciation, if you think back to kind of accounting, or if you haven't done any of the accounting papers yet, I'll just explain. Depreciation uses a lot of estimates. To calculate a depreciation expense, you've got things in there like the useful life of an asset, the residual value of an asset, which is its scrap value at the end of its life. Those are estimates. So what you could do as a business, not saying we should, but if a business were to do a little bit of creative accounting, they could manipulate the useful life and the residual value of the asset to alter that depreciation expense. So let's say the business wanted to lower their profits because they wanted to lower what tax they're going to pay. They could artificially increase their depreciation expense by fudging the figures with things like useful life and residual value. So the taxman doesn't like that because he doesn't like anything that's subjective and estimates because it gives scope to manipulation. So he says depreciation expense, you're not allowed to deduct that when you're calculating a taxable profit. You are when you're doing accounting profit, but not when you're looking at taxable profit. There's another kind of few disallowable expenses as well. You've got things that are disallowable, like, accruals are usually disallowable. We usually use cash-based accounting when we're doing the taxable trading profits. So you've got things like accruals, prepayments, all of those are not allowed. Other things is you've got things like client entertainment is a disallowable expense. And that's because if you wanted to lower profits at the end of the year, you could just have an absolutely brilliant Christmas party, invite all your staff, all your clients, spend a load of money, have a great time, and you've lowered your profits in the meantime and lowered your tax bill. So that's why it's not allowed, because the government and the tax authorities don't want you to do that. There's other things as well, you don't really need to know them, but things like donations to political parties, fines for things like parking, they're all disallowable expenses. But it works the other way as well. Sometimes there is income that is included in the accounting profit, which isn't actually taxable, so it's not included in the taxable trading profit. And the main things that you see with that in the UK is things like government grants. So the government might give you a grant, an income, to help towards something, help towards employing people in a disadvantaged labour community, for example. And it would be unfair to get a grant for that, get an income for that, and then them also tax us on that income. So there is some incomes which are exempt from this tax. So what we need to do then is we've highlighted a number of differences between taxable profit and accounting profit. We now need to create a pro forma, and that's what we've got in our notes here, because it's going to take accounting profits as our starting point. So that accounting profit is profit from the statement of profit or loss. And it's going to try and make a number of adjustments for all those types of things we've spoken about to get us down to the taxable trading profits. And that is the thing that is actually going to be taxed at whatever the tax rate is in the country to give us the tax payable. So aim of the game, start with accounting profit, get down to taxable profit. Now I've noticed a couple of questions. What does the first line under disallowable expenses say? Depreciation. Sorry, I used a bit of shorthand there. So depreciation expense. So if we're starting off then with that accounting profit and we're going to adjust it, one of the things we need to do is add back any disallowable expenses. So disallowable expenses will be told to us in the question. Now, some of you may work in tax. You may know absolutely loads of knowledge about tax, which is great, but in the exam, you can't use the rules that are in the UK. You have to go in there with kind of a blank canvas, and everything that you need will be told to you. They'll come up with some imaginary country and they'll say in country X, disallowable expenses are staff entertainment or client entertainment. They'll tell you the rules. You just need to know that whatever they say are disallowable expenses, you're adding them back in. And that's because they're originally deducted from profit, but they're not allowed to be deducted from the tax profit. You would then also deduct any exempt income. And again, even though we know in the UK exempt income is things like government grant income, we have to follow the rules of the question. They will tell us what is an exempt income in their country that they've made up. We just need to know to deduct it. And that's because it is included in accounting profit, but isn't included in taxable profit. We've talked as well about depreciation, how the taxman doesn't like depreciation. It's far too subjective. So we have to add that back because it originally would have been deducted from accounting profit. But it's not the end of the game with depreciation, because although the taxman doesn't like accounting depreciation, he says, hang on a minute, I'm still going to recognise the fact that your assets are being used up. So instead, I'm going to give you something called a tax depreciation allowance. And that is the taxman's version of depreciation. It's what you might have heard in the real world be called capital allowances. And again, the rules to how to calculate this tax depreciation allowance will be given to us in the exam. We just need to follow the rules of the question and know that that's what we're allowed to deduct, because that's the taxman's version of depreciation. It's much more black and white. It's much more rules based. In the real world, you might have heard of things like write-down allowance, first year allowance. That's what this means. So once you've made all those adjustments, you get down to the bottom, you've got your taxable trading profits, you're going to multiply it by whatever the tax rate is in that country, and that will give you the tax that is owed to HMRC or the local competent jurisdiction. So you need to learn this pro forma. In chapter 2, we're going to have a go at applying it. So you might want to fold the page down or put a little sticky note in so that when we do the questions in chapter 2, you can flip back to this pro forma and learn or have a go at applying it. So I'll pop in big letters here. You need to learn that. There's 2 you need to learn in your exams. Is this one for taxable trading profits, and then the other one is going to be for capital gains tax. They're the only 2 pro formas you'll need. Okay, so just on the next page, they've debriefed this pro forma a little bit more. They've said the rules for what is allowed, what is disallowed, vary depending on the country's tax regime. That is why in your exam, the specific rules will be provided to us in the exam. So everything we need will be given to us, apart from the pro forma. You need to know the pro forma. They've then said things like exempt income. We know that's income which is not their main trading activity. In the UK, that was things like government grants. We've got disallowable expenses, and we said that was things that are not allowed to be deducted, so expenses which are not allowable or not deductible. And in the UK, that is things like client entertainment. But again, they'll tell us in the exam what is disallowed. Depreciation, we said that's not allowed, it's added back. Instead, you get the taxman's version of depreciation, which the specifics for how to calculate that are given in the question. Okay, so that's pro forma number 1 that we need to learn. We'll have a go at applying this in chapter 2, so it's not the end of the road for this, we'll come back to it. Any questions then on this first pro forma, the taxable trading profit, before we look at the other one? No? All right, let's have a look at the next one then, which is all about capital taxes. So this is how to calculate a capital gains tax, which you would need if a business was to dispose of an asset and make a profit on it. They've made a gain on the disposal of an asset. So for this one, different things that they could dispose of. Maybe they dispose of investments, they dispose of non-current assets, they dispose of stocks and shares or property. And they said at the most simple level, at the most basic level, a gain is calculated as the proceeds minus the asset cost. However, doing the sale proceeds minus the cost of the asset is not really going to cut it for your exams. It's a bit too simple. So instead, we have a big pro forma that splits out exactly what costs are deductible and exactly what sale proceeds are taxable. And that's what we've got in the pro forma below. So we're going to start off with the proceeds that we have received from the sale of an item. Now, I'm going to work through this example in the context of a property. So with a property, we've got the sale proceeds. So maybe you've sold it for £100,000. So you pop that in. You're then going to deduct any costs to sell. Now, what this is any cost you've incurred now to sell it, not historical costs when you bought it. It's things like estate agent fees, things you've had to pay today for the sale of this item. So I'll pop in as an example, estate agent fees. That will then take you to your net proceeds. So that's just netting off the proceeds and the costs to sell it. What you can now do is deduct any of your historical costs, which is costs that have happened in the past to maybe buy this asset. So first one is, what was the original cost of the asset? How much did it buy you, or how much did it cost you to originally buy the building? You then can deduct any costs to buy. Now, cost to buy is any incidental costs when you bought the asset which you incurred. So maybe incidental costs were things like you had some solicitor fees when you first bought it to sign over the deeds of the property. Or maybe when you first bought it, you had some stamp duty land tax that you had to pay. So any incidental costs when you first bought it. You are then also allowed to deduct any enhancement costs. Now, the examiner loves this. They love trying to trick students with enhancement costs, because enhancement costs are allowed to be deducted, but not repairs and maintenance. And that's because to be able to deduct it, the cost has to be something that improved the economic benefits of this asset. So something like an extension or an expansion or a new floor, not new, yeah, kind of a new level. So like it did have 2 floors in the building, now you've got 3 floors in the building. So I'll put something like extra building layer. All of those are allowed. But as you've just mentioned there, Maria, anything that is kind of capital expenditure in nature is allowed. Anything that's revenue expenditure in nature is not allowed, absolutely. So things like new paintings or new radiators or a new roof or repairs, maintenance, anything like that, it's just restoring the building back to what it was when you first bought it. That is not an enhancement cost. So it is never, never, never repairs, maintenance. They are not allowed. So deduct your enhancement costs. And then what you're allowed to deduct is something called indexation allowance. Anybody know what that might relate to? I'll come back to your question in a second, Victoria. But indexation allowance, any ideas? Yeah, absolutely. It's inflation. So sometimes I might have bought a building for 100 grand originally, and now I've sold the building for 120 grand. I've not done anything to it. I've not enhanced it. I've not spent any extra money on it. It's just increased in value, maybe because of inflation. So it would be unfair to tax me on an inflationary gain because that's out of my control. That's something that I didn't have an impact on. So indexation allowance, how it's usually calculated is they usually give you an indexation percentage in the exam. They usually say like 5% indexation allowance is allowed. So you take that percentage and you'd multiply it by your historical costs. And that's because it's only historical costs that are allowed to be indexed, because they're the costs that have happened in the past. So they're the ones that have actually been affected by inflation. Things like your cost to sell, the cost you're incurring today now for estate agent fees, for example, that's a cost incurred right now, today. So it doesn't need indexing. It doesn't need to be accounted for inflation because no time has passed between incurring that cost and the present day. So it's just your historical costs. So something, again, that the examiner loves tricking people up on. Right, a couple of questions. Let's address these. So Abu, is this capital gains tax applicable to both businesses and a normal person? Good question. So in the exam, it will only be for businesses. In reality, what happens with capital gains is you as an individual get a capital gains tax allowance. So you get a certain amount of money that you're allowed to earn from the disposal of assets tax-free. Anything after that, you would then get taxed on. So for example, I've got a property down in London when I used to work at PwC. It's the absolute bane of my life. It causes me so much money and stress that I tried to sell it last year. Currently renting it out, but I tried to sell it. And when I was hopefully in the midst of selling it, didn't happen, but when I would have sold it, my accountant kind of drew up a whole capital gains tax pro forma for me. So she popped in like the proceeds of how much I wanted for it. She deducted things like my estate agent fees because they were advertising it for me. She deducted the original cost of my asset. And then when I bought that property, I spent quite a lot of money on it. I did like extensions and things like that. So deducted all of that, deducted inflation, and then the net amount would have been what is taxable. So yeah, it does apply to real life. If you sell something like a vintage car or a sports car that appreciates in value because maybe it's, you know, going up in value, or a property, then yes, it would be taxable. There was another question by Victoria. Good question, but it's not going to be in your exam, but I will explain it anyway. What if you have repairs or maintenance and it's improved? So you've replaced a roof and it's improved it. So good example, because you could replace a normal roof maybe with a roof with solar panels. And if that's the case, what you are allowed to deduct is the extra bit. So if you are replacing it like for like, that bit's not allowed to be deducted, but then maybe the cost for the extra bit of the solar panels, that would be allowed to be deducted. It's like if you replace a fridge with a fridge freezer, it's not like for like. So the cost of replacing it like for like is not allowed. And then any extra for the freezer element, that bit would allow to be deducted. But you won't get that in your exam, so don't panic. It's not that complex. We capitalise new bedroom furniture for a hotel for a few rooms. Maybe if you can prove that it was, also it depends, because it depends if you're talking about accounting or tax. Because if you're talking about accounting, then the rules are slightly different with taxation. But new bedroom furniture, it depends if it's replacing and repairing it, or kind of it's better. So if you've replaced like a single bed with a double bed, then you would be allowed to capitalise the extra. Or when you bought the building or you bought the hotel, if you bought it as an empty space and it didn't have anything in it, then the purchase of a bed would be the first purchase, so that would be capitalised. But we're getting into the nitty-gritties of it there. It's not going to be that complex in your exam. Okay, so we do this pro forma, we get down to the bottom, and then we have a chargeable gain at the bottom. And it's that chargeable gain that you then multiply by whatever the tax percentage is, and then that will give you your capital gains tax. That is what is subject to taxation. So they've just mentioned in bold at the bottom, they've said these two pro formas are going to be covered in loads more detail in the next chapter. We're going to have a go at applying some figures, doing some calculations. It's a lot more exciting. It's less me talking and more you doing. So keep these two pro formas handy because you will need them again in chapter 2. So capital gains tax pro forma and that taxable trading income pro forma. They're the two you need to learn for the exam. So we're going to take a break in just a second. I'm just going to quickly flick onto the next page and do the other two forms of direct tax, and then we can take break and do the indirect tax after break. So the other two forms of direct tax, these are dead quick, it's just property tax and wealth tax. So property tax, in most countries, there is tax on land and buildings. This is things that is your stamp duty land tax, but you just need an awareness that stamp duty, land tax, property taxes, they are a direct taxation. They're not just on things like properties, but they could also be on things like cars, boats, other assets. So you could get a true or false question. Is there property taxes on boats? You could say, yes, there is. Makes you think of Monopoly. Yeah, I love a good game of Monopoly, although I'm quite bad at it. I end up mortgaging everything and ended up being bankrupt pretty quickly. So maybe not the best one to play with. Okay, wealth taxes. Wealth taxes we don't actually have in this country. Wealth taxes are if you are a really, really wealthy person. And they add up all of your assets. Your assets could be things like pension funds, insurance policies, works of art, expensive sports cars, vintage items, expensive paintings, art gallery paintings, whatever it is that you've got, which is a wealth item, they add it all up. And if it's over a certain threshold, you get taxed on it. So it's really controversial, and we don't have it in the UK because it is very controversial, but they do have it in some European countries. So I think they have it still in France. I think they have it in Switzerland. You don't need to know how to calculate it. You just need to know what it is. I have it in Romania. Yeah, so some countries do have it still if you're a wealthy person, but we don't really have it in the UK. Okay, so that is our direct taxes boxed off. We've got taxable trading income, which is direct tax, and we've done a pro forma for. We've done capital gains tax, which is a direct tax, and we've done a pro forma for, because you get tested numerically on them. And then property and wealth taxes, you just need an awareness of. Okay, so we'll take a little break there. It's probably quite a natural break before we come back and do indirect taxes. So if anyone does have any questions so far or wants to ask me anything, please let me know. We'll take 15 minutes. So if you want to pop back at 10:57, and as I say, any questions, send me a chat. So you can do it on the private chat or on the group chat, whichever, and I'll answer those if you're stuck on anything. Right, welcome back everybody. Hopefully we had a good little break. It's lovely weather here, so hopefully it's nice and sunny where you guys are as well, and get a bit of sunshine on your faces over the break times. So we're going to have a look now at indirect taxes. So we've looked at the direct ones. We're going to look at indirect next. So indirect taxes, we said this is taxes that basically relate to consumption. So it's taxes that are borne by one party but paid over by another party. So the example of the chocolate bar before, my pocket is lighter because I've had to pay tax, but actually Tesco's are the one who paid the tax over to HMRC. So VAT is our biggest example. But if we have a look at indirect taxes a bit more detailed, there is actually two types. There's something called a unit tax and something else called an ad valorem tax. Now, a unit tax is a flat rate per item, regardless of its value. And if we have, they've mentioned excise duty. So if we have a look underneath at the box that says excise duties, what this basically is taxes on things that are quite bad for us to try and avoid overconsumption. So it's things like taxes on alcohol, taxes on tobacco, and any of the money that's collected from these taxes is used to try and pay for things like healthcare to help us for taking the things that are bad for us. So that's what they mean by excise duties. It's a tax on something to try and discourage overconsumption. Yeah, sugar tax is another one as well, absolutely. And the other type of an indirect tax is an ad valorem tax. And this is the one that actually you need to calculate in the exam because this is VAT. So ad valorem tax, rather than it being a flat rate, this is something that is added to the percentage value of the goods. So they've said here sales tax. Sales tax is another word for VAT. They mean exactly the same thing. And again, we've got a little box underneath explaining this. It is added to the purchase price. So for example, chocolate bar is £1, add 20% on it. And they've said it could be a single stage or multi-stage. So that just means in the UK, we just have single stage where it's taxed at the end when you buy the good at 20%. But multi-stage means that it's also taxed during the production. So at each level of production, it's taxed at that VAT rate as it passes through the production process. So the one that we're going to have to actually calculate in our exam is this one here, ad valorem taxes. And they usually try and get us to calculate that using 20%. They might give us a inclusive VAT price or an exclusive VAT price, and we have to decide whether we need to add or subtract the VAT and how much that actually is. So if we just look on the next page, we've got a couple of details on VAT and how to actually calculate it. So they've mentioned here that VAT is charged every time a product is sold. And that's what we call output tax, because you're selling your output and you charge VAT on it. However, if you are a VAT registered business, then what you are allowed to do is claim back any of the tax you have paid to get the goods into your business. So for example, let's say I'm a clothes designer or I'm a clothes creator and I make clothes, then when I buy my input, I'm going to be buying things like the cotton, I'm going to be buying things like the thread and the needles and the embroidery to put on these clothes, and then I'm going to sell the finished garment. Well, when I sell the finished garment, I'll be charging output tax on the finished garment and I'll have to pay that over to HMRC. But when I bought all the cotton, the thread, the needles, the embroidery, I would have paid a price that includes VAT on that. Exactly, Sophie. So you can reclaim any of the input VAT that you've paid to purchase the raw materials or whatever your inventory is, whether it be raw materials, work in progress, finished goods, that inventory you've bought, you can reclaim the VAT on that if you're VAT registered. And that's what we call input tax. The tax to get the goods into your business, you can claim it back. So what that means is at the end of the year, the VAT that is payable to HMRC is any of the output tax that you've charged to customers when you've sold your clothes, minus any of the input tax that you had to pay when you purchased the raw materials. So you only end up paying the net amount. So they've just defined that below. They said output tax is VAT that's charged on the sales to customers, whereas input tax is the VAT that you originally paid on your purchases, on your inventory, when you originally brought the goods into your business. They've just reminded us at the bottom that sales tax and VAT mean exactly the same thing. Now, in terms of VAT rates at the bottom, in your question in your exam, they will tell you what VAT is. And all the questions that I've ever seen, they mainly either say it's 0 rated and there's no tax to calculate, or it's standard rated and it's 20%. But they will tell you in the exam what the tax rate is in this made up country. So in the UK, we have standard rated goods, and they are taxed at a standard rate of VAT, which is, for example, 20%. Now, there is also higher rated goods. Now, in the UK, we don't actually have these, but in some countries, they charge a higher rate of VAT on specific items. So maybe they charge 30% on a specific item in a different country. They'll give us the rules in the question. You also have the opposite, which is reduced rate, which are taxed at a lower rate than the standard. And in the UK, we do have this. We charge 5% VAT on things like home energy, so gas for your home, so things like British Gas. And we also have it for things like children's car seats as well, are 5%. So I'll just pop in brackets, things like children's car seats, home energy, they're all reduced rate and they're charged at 5% VAT. Question, I work for a catering company that supplies food to children in schools and we buy a lot of bottled water which is vatable. Does this mean we can claim this back as this is input tax? So I'm going to come on to that in a second. I'm not entirely sure on the bottled water in the UK, but if it is vatable, then yes, you can reclaim the input tax on that. But it might be that it's, even though it's vatable, it might still be a 0 rated good. I know that I'm going to talk to you in a second about the difference between 0 rated and exempt goods. Because 0 rated goods, what they are is taxed at a rate of 0%. So even they're classed as vatable, they're within the scope of the VAT system, you still charge 0% VAT on them. And in the UK, this is things like children's clothes, they fall in this bracket, which is absolutely fabulous because I've got small feet and a small body, so I can fit in children's clothes and get them cheaper, which is brilliant. And the other one, yeah, so it's also most foods. But by foods, we have to say foods that are kind of essential for living. And it's usually things that are like raw ingredients. So things like flour, eggs, because you'd use those to make bread. Biscuits is classed as one as well, because it's classed as natural, well, not natural, but good fats, because you need some fats and sugar in your diet. So some foods are classed as 0 rated. So that means when you sell them on to the customer, they are charged at 0% VAT, which makes them a little bit cheaper. However, there is also exempt goods. Now, exempt goods are completely outside of the 0 rated system. They're completely outside of VAT. They are not subject to VAT at all. You don't charge output tax on, you also can't charge input tax on them. So a lot of people do confuse the two. Now, they are very, very different in terms of both of them. I'll write it out here in terms of their output tax. Both of them, whether it is 0 rated or exempt goods, they charge no output tax because 0 rated is 0%, exempt is completely outside the scope of VAT. But why they are different is in terms of the input tax, because I said earlier that if you're VAT registered, you can reclaim any of the VAT that you paid on your purchases. Zero rated goods, these guys are within the VAT system, so they can reclaim their input VAT. However, if you are exempt goods, then we say that you're completely outside the scope of the VAT system, so you can't reclaim any input VAT. And that's because you're just not in the VAT system. You're outside the scope, you're completely exempt. So that's the difference between them. The output tax is the same, neither of them charge it, but the input tax, if you're a zero rated goods, then you can reclaim input VAT on your purchases, whereas exempt people cannot. So there's obviously a lot of fun and games in the real world as to whether something is zero rated or whether something is exempt. And there's a lot of real world examples that have happened where there's been massive tax disputes of whether it is a zero rated or exempt good. So yeah, so there's some examples on the next page. So just flick over. There is zero rated supplies. They've said things like basic food, so simple bread, things that you need to survive, children's clothing and exports. Exempt, they've said things like gambling, sports activities, insurance and finance. So as I was just saying, there is a lot of debate in the industry as to whether you're a zero rated or exempt good. So there's a lot of cases, for example, Jaffa cakes has been one that was a really publicised event as to whether they are a cake or whether they are classed as a biscuit. Because one of them is vatable, one of them is exempt. So that's been a big case that's been in the courts recently. There's also Pringles as well, so the crisps, and that's because there is a debate as to whether they're classed as crisps or whether they're classed as a cake, because cake is in the zero rated, whereas crisps are exempt. So there was a massive debate, and apparently it turned out to be a zero rated good because it's classed as a cake because apparently Pringles have more dough than potato content. They're all a uniform shape as well, which crisps aren't. So fun fact of the day, Pringles are classed as a cake, not a crisp, which is why they can therefore reclaim any input VAT. There's a current one going on at the moment as well, I think. I don't know if it's finished or not, but there was about the strawberries and cream sandwiches from M&S. Don't know if anyone's seen those. They're really weird. It's like, looks like a sandwich, but it's got like strawberries and cream inside. So that's a current debate about whether it's classed as a sandwich and savoury or whether it's classed as sweet and therefore kind of exempt because it's kind of got sugar tax and stuff. So there's a lot of debates going on as to whether something's zero or exempt. There's lots of things you can read around if that's interesting to you. Yeah, I've seen that one as well. Morrison's pizza with mini eggs. There's some things that just look so wrong, isn't there? So there is lots of debate going on. Now, they've just said at the bottom why all this debate between zero and exempt goods is because I've just mentioned input tax can be reclaimed only on taxable supplies. So zero rated, standard rated, reduced rated, you can reclaim, but exempt goods are completely outside the VAT system. So you cannot claim any input tax back on them. So most businesses try and get into that input tax bracket by saying that they are vatable as opposed to wanting to be exempt. Now, the main thing to do here with taxation is to actually go ahead and calculate some VAT. Now, calculation of VAT is actually pretty straightforward. It's not got a big computation like we saw for the taxable trading profit and the capital gains tax. Instead, it's just a little calculation for whether you have been given an exclusive price or whether you've been given an inclusive price. Now, the difference is if you're given an exclusive price, this means that the price you have currently been given doesn't include the VAT. So we therefore need to go ahead and calculate what is the VAT to add on to this. This is also known as the net price. So exclusive is the same thing as a net price. So if you've been given a net price, to find the tax, you need to take what is that net price or that exclusive price and multiply it by the tax rate. So if I give you an example, we'll say that we have an item price is £10, currently exclusive of VAT. What is the standard rate VAT on this item. So in that case, we've been given an exclusive price. So we take £10, we'd multiply it by 20%, and that's going to give us £2 VAT. So then if the question said, what's the VAT on this? You could say £2. The question could also say, what is the VAT inclusive price? So if you're then asked for what is the inclusive price, well, exclusive was £10, VAT represents £2, so your inclusive price would be £12. So it's not tricky, it's quite nice. But the only way people get confused with these questions is if you are given an inclusive price, it's slightly different. So if you're given an inclusive price, this means the price that you have currently got does include VAT. Now, if something includes VAT, we would call it its gross price. So an inclusive price, same thing as a gross price. So here, what you would need to do is take the inclusive price that's been given to you, and you can divide it over 100 plus the tax rate, and then multiply it by the tax rate. Now, that's one way of doing it, if you like that. There's loads of other ways of doing it as well. So I actually prefer taking the inclusive price and multiplying it by the tax rate over 100 plus the tax rates. I know everyone's different. Some people prefer that. Some people prefer the one that's been given to you in the books. Doesn't really matter. You get to the exact same answer. So this time, if we take the same example as I did before, so example, we've got an item price of £10. This time it is inclusive of VAT. If we want to know what the VAT rate is, we can take £10, which is the inclusive price, times the tax rate. Well, the tax rate, if it's standard rated good, will be 20%, over 100 plus the tax rate, which would be 120%. And that's going to take you to £1.67. So you can see the difference there between the VAT when it was an exclusive price, which was £2 VAT, versus the VAT when it had an inclusive price, which was £1.67 VAT. So very, very different. So just watch out with that one if you get that in the exam. So if the exam was to then say kind of what is the net price, exclusive of that, it would be £10 minus £1.67, which would take you to £8.33. And that would be your net price. So always watch out what the examiner's asked for. Yeah, exactly, Hannah. When you go to Costco and they give you the exclusive price and the inclusive price, but at least they give you the inclusive price, because I've been to a couple of shops before, especially if you are overseas as well. I think that America does it, and all the prices, they look great and they look really cheap, and then you go to the till to pay and they add on the 20% at the till and you get a shock because you're like, oh, didn't realize it was that much. I do that all the time with a company that I order some stuff with online. It's quoted exclusive of VAT, so when you actually get billed, it's a little bit more than you thought. So there's a little bit of a VAT return underneath. Now, you do not need to learn this. I'm just going to say here, not learn. This is here more for flavour of what does a VAT return look like. You won't get tested on this. But in reality, if you're doing a VAT return, you'd list across the top what is the net price, what is the VAT, and what's the gross price, because we know that the net price plus the VAT gets us to the gross. And then it's just listed below what is your output, so the things you're selling, your sales, what is the standard rate, the zero rate, the exempt rates, and then your purchases, how much have you purchased at the standard rate, the zero rate, the exempt rate, and you've got your net prices, your gross prices, and the VAT. Yeah, there's quite a lot of different ways to get to the VAT prices, Jennifer, like you flagged. there as well. So another way is you can kind of like divide it by 5 as well to get the price. So there's loads of different ways of doing it, but there's a couple that I've popped on there. In the Kaplan notes, I've got one as well. But you'll get your own way of doing it and find one you like. So just a little bit of an example, nothing too complex, just example number 1. Have a little read through, true or false, tick box, see what you think. Okay, let's have a little run through this then. So first one, VAT is a direct tax. We should have all ticked false there because we've been banging on for the last half an hour that it's actually an indirect tax. Next one, Jake, a SEMA student, is working for a small accountancy practice. He advertises the bike for sale and sells the bike for $100. Should they charge VAT or not? They've said they don't think they should charge it. That is probably true. Now, it kind of opens up a bit of a debate here as to whether Jake or Jake here, is seen as trading or not. Now, the fact that he's put it on his workboard, it's only 100 quid, he's probably not being seen as trading. But also the bigger point here is that actually he's probably not VAT registered anyway. He's just a little guy on his own selling his bike. It's hardly going to be a business unless he's buying and selling bicycles. So I would say that is true. He wouldn't charge VAT. Businesses may keep all the money. If only that were true. False. They actually pay it over to HMRC. And then the last one, similar to the one about Jake here, we've now got Fred with a plumbing business. But this time his plumbing business is registered for VAT. It replaces a tap and charges them $60, including VAT of 10. The VAT charge belongs to Fred. That's not true either. It's the same as the above. He'd have to pay that over to HMRC. And that's because this time he is registered for VAT. It looks like he's got his plumbing business. That's his trade. He's making money. He's trading with plumbing services. So he needs to pay that. Okay, any questions then on the indirect taxes? I noticed there was a question in the chat panel around custom duties. I responded to that on the chat because I've missed it before. So if anyone's got any other questions, let me know. And what we're going to have a quick chat about now is just the last part of this chapter, a bit on employee taxation. Oops, laptop's having a moment. 1 second. So employee taxation, you do not need to calculate. You just need to have an awareness of what goes into it, what's made up of it. You don't need to start calculating it. So employee taxation, things that go in here is, first of all, you need an awareness of personal allowance. Now, personal allowance is basically the amount of money you can earn tax-free in the UK. So in the UK, it's just over £12,500. You can earn that tax-free. After that, you start paying tax. Number 2, income. We need to know that all forms of income are taxable, whether that be personal trading income, personal employment income, property income, income from capital gains is all taxable. Benefits in kind. These are also taxable. Anyone got any ideas of benefits in kind? Anybody get any at work? Company car. Yeah, absolutely. That's one. So that's classed as a company benefit. Christmas bonus. I'd probably pop that in other income actually, in the income bit. But yeah, bonuses are taxable, which is very upsetting because I remember when I first got a bonus at work and I didn't realise that my bonus was taxable. And it really upset me. Private healthcare. Yeah, absolutely. I think I was just a bit naive actually when I first started work because I didn't realise that was a taxable benefit either. It was only when I got my tax bill at the end of the year I was like, oh, that's a nice unexpected tax that's on my P11D. What else have we got? Shares. So it depends on what the share scheme is and whether they've kind of vested or paid out on it. So I'll leave that one for now. Gym membership, yeah, that could be one. Any gifts over £50? Yeah, so any form of kind of gifts that aren't classed as trivial. Another one is kind of loans. Some people get loans from their employer, and if it's at a rate that's kind of lower, the interest than the bank, then it's classed as a preferential interest rate, and that is therefore classed as a benefit. There's loads of different things. You can get that accommodation as well. If, for example, you work in the hospitality industry, childcare vouchers. I think they're tax-free actually. I'm not sure on childcare. But accommodation, you've got, for example, hospitality. If you work in a bar or a restaurant and you get to stay there and you have a room there, that's a benefit. So all of these things I've added up and they are taxed. Expenses. Now, some things are actually allowable expenses. So similar to what we were looking at before for a business, you yourselves could have expenses that you incur which are actually deductible. So one which all of you probably have is your SEMA subscriptions. So you might have to pay an annual subscription charge. Now, I don't know about you guys, but my ACA subscription, I'm quite lucky. I get to get it all back from my employer. They reimburse me because without that, I can't teach. So my employer reimburses me, so it's not actually out of my own pocket. But if, for example, I worked in a different industry, maybe let's say I set up a hairdresser's and I had nothing to do with accounting anymore, but I still wanted to keep my subscription, then that would be an allowable deduction because it's a subscription towards a professional qualification. Other things that are allowable expenses, so you've got subscriptions in there. You might have things in there like travel. Now, a bit of a funny one with travel, because I work in the Manchester office, which is my permanent home office, Kaplan's Manchester office, but I actually live near Blackpool. So it takes me just over an hour to get to work on the train, and train fares are definitely increasing. But that train fare, I can't actually expense that as an allowable expense on my personal tax computation because I'm going to a permanent place of work. However, if, for example, Kaplan turned around and said, oh, Gemma, please can you make your way to London next week to go and teach some classes in London, then I would be allowed to have as an allowable expense on my tax computation that travel because it's to a non-permanent place of work. So travel anywhere that is not your permanent office is allowed to be an allowable expense. And then you've got PAYE. We've already spoke about that already. That's your taxes deducted as and when you earn it. So there's a couple of notes on the next page just to kind of summarise these. So you've got employee tax, everything is taxed, including benefits. We've come up with most of these: cars, accommodations, loan, insurance. You guys got a few more as well. Deductions, we said some things are allowed to be deducted, such as professional subscriptions. We've just talked about business travel, but that business travel is to a temporary place of work, not your permanent place of work. Contributions to pension plans, they're a tax allowable deduction, a good way of making sure you stay in a certain tax bracket. Donations to charities as well, they're allowable deductions. Social security benefits, you need an awareness of those. That is basically national insurance contributions. So national insurance contributions, they're automatically deducted by your employer and they're used to fund things like hospitals, pensions, that kind of stuff. And then personal allowance, we've mentioned that's your tax-free allowance, the amount you're allowed to earn up to tax-free. Okay, so a little bit of a quick example again, true or false. Just change the bottom one where it says taxable trading income, just change that to taxable salary. It'll make a bit more sense when you read it. Have a go, we'll have a debrief of those in just under a minute's time. Okay, let's have a little run through. So the first one we've got is net income is the figure after deducting your personal allowance. What do we think about that? True or false? You can put a T or F in the chat panel. Yeah, lots of falses in there. I'm going to agree as well because actually net income is what you actually receive. So that's what lands in my bank account at the end of each month from my employer. So it's after deducting personal allowance, but it's also after deducting things like your tax, your national insurance contributions, any exempt income. So it's what I receive in my bank account. We've got income tax due for the year is before deducting amounts paid under PAYE. Bit of a weird question. I'm going to explain it, but just out of interest, what did we say? True or false? Okay, yeah, quite a lot of trues. You're correct if you got true. If you weren't sure, that's fine. Or if you put false, that's also fine because it is a bit of a funny question. So what it means is income tax due is before deducting PAYE. Now, the easiest way to think about this is if you are somebody who maybe has two forms of income. So what happens at the end of the year is my accountant will create my tax computation for me and they'll say, okay, how much has Gemma earned from Kaplan? And they'll pop that onto my tax computation. Now, I mentioned I also have a property that I've desperately trying to sell. I can't sell it, so I rent it out. So when I rent that out, I also get some property income. And then at the end of the year, my accountant will add them up together and she'll say, okay, here's your total income. and therefore, what is the income tax that is therefore due? However, what will then happen is she'll go through these and think, have you actually already made any contributions to HMRC this year already? And I have, because Kaplan have automatically been deducting my salary for me for PAYE. So they'll then say, okay, what is any PAYE that has already been paid? And then that net amount will give me the tax that is actually payable. So in this question, they've said income tax is before deducting amounts paid under PAYE. That is true because income tax due is there, and then they'll deduct the PAYE to say, well, what's left to be paid. So that's why that one's true. We've then got taxable salary is the amount after deducting personal allowance. That is true. That is what is therefore subject to your taxation. Lots of people in the chat looks like you've got true as well. So well done there. So just a little example. Over the next page then, we've now got some benefits of pay as you earn. So pay as you earn, some of the benefits are that tax is collected at source, which means you're less likely to default on payments. So if you think about it, they're deducting my salary automatically every month and paying it to HMRC, as opposed to if I waited till the end of the year and then got a big tax bill, it's unlikely that I'd actually have that money saved and ready to hand over. So it causes less likely to default if they take it regularly throughout the year. You receive regular employer payments, which can help the government with things like cash flow. So instead of receiving a lump sum, receiving PAYE every month can help them with budgets. It also means that HMRC only have to deal with the employer because Kaplan deal with my pay as you earn, they deal with all of my colleagues' pay as you earns. So if there's any problems, Kaplan contact HMRC on my behalf instead of them having to speak to me, which means it saves a lot of time, it becomes more efficient. It means admin costs are also borne by the employer, which means it's cheap for HMRC to collect. Now, again, we've got a little bit of a pro forma here, but I'm going to say this is not a learn list. And that's because it's just here for a little bit of flavour. You just need an awareness of employment tax, such as all those things we've gone through. This is just here to give you an idea of what happens in the real world. You'd have salary, someone mentioned before about bonuses, benefits, all added in. You'd then deduct your allowable deductions, things like subscriptions, maybe pensions, maybe any other allowable expenses. And then that takes you to your total taxable income. You deduct your personal allowance to give you your taxable employment income. And the reason we don't actually do this in your paper is because then that goes through quite a complex series of figuring out how much of that is taxed at maybe 20%, how much of that is taxed at 40%, how much of that is taxed at 45%, and that's what they do in the UK. It's different in every country. So just an awareness of what's taxed and what's allowable deductions. Is this pro forma applicable to both large businesses or someone self-employed? So with large businesses, they automatically deduct your pay as you earn for you, but then individual. So for example, with me at Kaplan, they'll automatically deduct my tax and what I owe HMRC, but then maybe if I've had other expenses that are allowable deductions, like I'm working from home and I'm allowed to maybe reclaim some electricity costs because I'm working from home, that won't have been factored in when Kaplan's done their tax to HMRC. So then I would personally have to fill out a self-assessment tax return at the end of the year to reclaim any of this. So this is more for individuals. At the end of the year, you will create your self-assessment tax return of what's your salary, how much tax you think you owe. If you can reclaim some extra or pay some extra, then you do. Large businesses mainly just deal with pay as you earns. Last little bit in this chapter, just a bit around authorities, and then we've got a bit about avoidance and evasion, and then we're going to do some questions. So powers of authorities, we've spoke about these quite a lot already. These are like your competent jurisdiction, the people who have the power to impose and collect taxation. But here we're going to look at what can they actually do. What power do the likes of HMRC have? Well, they have the power to review and query filed returns. If I give them a self-assessment tax return and they think it looks a bit dodgy because it's half the amount of tax as it was last year, they can ring me up and query it. They have the power to also request special reports if they think inaccurate information has been submitted. So maybe they have the power to ring me up and say, Gemma, can you please submit me all of your pay slips? Because I don't believe that what's on your self-assessment tax return is what you've actually earned. They can examine records from previous years. They said in the US they can go back quite a long time, back 20 years, but you don't need to know that, just that they examine previous years. They can enter and search an entity's premises and seize documents. So maybe if they think a business is creating fraudulent expenses, they could enter a property, the business, and maybe seize all of these invoices for all these fake sales that they think they're having and, prosecute them. They can also pass on information to foreign tax authorities. So if you try and run away and don't pay your tax, then they can pass it on to wherever you've run away to. And then the last bit on tax avoidance and tax evasion, we spoke about briefly at the start of the session. We said tax avoidance is something that is legal. Now, yes, you're all correct in that most of the time it is frowned upon if it's used badly. So the likes of kind of Amazon, Virgin, kind of like setting up offshore tax havens. But sometimes it's actually very good. When I did my ACA exam, I had to do a whole exam it was called Business Planning and Taxation, of how to legally avoid taxation. So it's trying to arrange your tax affairs within the scope of the law just to reduce your tax liability. So maybe that's things like you've got a husband and a wife. Maybe the wife is pregnant and she's not working anymore, so she could transfer her personal allowance to the husband. So the husband gets twice the amount of personal allowance. So that's tax avoidance. The husband is avoiding paying more tax, but it's legal because the wife has transferred her personal allowance. So there is legal ways of doing it, but obviously there is illegal ones as well. Other ways you can do legal tax avoidance is maybe instead of being a sole trader where you're taxed, the business profits are taxed on your personal income at the 20, 14, 45% tax rates. Instead, you could become incorporated and become a limited business, and then you're only subject to 20% taxation. So there's different ways of doing it, and it could be legal. Now, tax evasion is obviously the opposite one. That is illegal. And that one is manipulating the tax system to try and reduce your tax payable. Now, there's lots of different ways of illegally doing this. Just for a little few examples, maybe you falsify tax returns. So you create a false tax return. Maybe you create fake expenses. So allowable expenses, maybe they don't actually exist, you've made them up. Maybe tax evasion is things like ghost employees or ghost suppliers, which means it says that you're paying employees or you're paying suppliers, but actually they don't exist, and maybe that payment loops back into the pockets of the directors. Maybe you are not declaring income. So maybe you have a property, but you're not declaring the property income to HMRC. So there's loads of different ways of kind of illegally avoiding paying tax. They obviously aren't advised, they are illegal, you would be prosecuted. And the government are trying to include multiple preventative measures to try and reduce tax evasion and a little bit of bad tax avoidance as well. So methods they've used to reduce this: reducing opportunity. So deducting tax at source, in other words, pay as you earn, is one way of trying to reduce it. Using third-party reporting, they've got simplifying tax structures. So that means reducing how complex they are and just making the tax rules a little bit more simple for people to follow. Increasing the perceived level of risk as well around that. So really kind of making a point on the news when someone is found out that they're avoiding or evading. Good communications between tax authorities and entities. And this is something we've really seen, which was that example that I said, like eBay, Airbnb, Depop, that they're increasing communications with them to try and catch people out. Changing social attitudes, so trying to make people think that the right thing is better to do. And then increasing deterrence as well, so penalties, increasing those. So a little bit of a fun exercise to wrap this chapter up. Have a go, tax avoidance or tax evasion, little tick box exercise. Okay, let's have a run through. So the first one, not advising a tax authority that they have erroneously repaid 10,500 rather than 1,500. What do we think about that one? Yeah, I would say as well. Hannah, Josephine, Catalina, Caitlin, Charlotte, absolutely, that's evasion. Doesn't look very good. What about deliberately changing the figure of a taxable trading income? Yeah, I mean, the word deliberately kind of gives it away there, doesn't it? What about the shares? Investing in shares with a grant, an exemption. Yeah, that sounds like quite good tax avoidance as long as it's legal, which it looks like it is. That looks fine. I mean, the next one, omitting, that clearly looks like evasion, just from that first word, doesn't it? Evasion and omitting. What about the next one? The way we set up a business. Yeah, tax avoidance. That looks like good tax planning. And the last one, what about the scheme? Yeah, absolutely. Avoidance. Looks like it's a good way of tax saving. All right, so that completes this first chapter. I know it was a lot of me talking, but the other chapter, the next one, chapter 2, is a little bit more practical. It's a bit more fun. But what is quite useful before we move on to the next chapter, I think, is just having a little look through some questions out of the exam kit. It's never too early to start, just to give you an idea of what kinds of questions you could get in your exam based off chapter 1. So you have got an exam kit. Now, where you would find this is on Bibliu of My Kaplan. So you need to click on My Kaplan, then Bibliu, which is your online bookshelf, and then on the Bibliu, you will have the exam kits. Some people might have had it in the post, but they're kind of putting a stop to that. So it's more likely you've just got it on Bibliu. So have a find of this for me. So you need to go on to My Kaplan, My Materials, Bibliu, and then you want exam kits for SEMA F1. And when you get there, I want you to have a go at a couple of questions for me. Now, it seems like a lot, but they won't take you long at all. If you could do for me questions 1, 2, 4, 5, 6, 7, 8, 10, 11, and 12. And it will just give you a flavour of the types of questions you could get based on this chapter. If anyone has any problems finding the exam kit, just give me a message and I'll show you on my screen where you can get it. I can see a message in the chat, struggling to get onto Biblio. If you can't get onto Biblio, it might be worth clearing your browsing data and cache history, and then trying again, going through My Kaplan, clicking on the link to Biblio, and then seeing if it works that way. And when you have finished all of those questions, if you can pop me a thumbs up in the chat panel, and then we'll have a debrief. Okay, looks like quite a significant amount of us have finished. So we'll have a quick debrief of these questions. So the first one, we've got competent jurisdiction. So we should have gone with the first one there. That's a country whose tax laws apply to the entity. The next one is a taxable person, and that should have been the second one, a person or entity who is accountable for the tax payment. Number 4, about a progressive tax. That's one that increases as our tax increases. So the best one there is going to be D. If we look at the others, A, that one is 1% of the selling price for all properties sold. So that is actually a proportional tax. B, we've got VAT. Well, VAT is an indirect tax anyway. That's kind of not what we're talking about here. And then C, that one is 2% up to 10 million and then 0.5% after that. So that one is the opposite. That would be a regressive tax. So that leaves D as our answer. We've then got 5, tax evasion. So we should have all put that that's the illegal one. Number 6, we've got an ideal tax system should conform to certain principles. Which one is not generally one of these? Though it might seem like it, it's C. It's not to raise as much money as possible for the government. Number 7, a direct tax. That's one that's levied by the person intended to pay. And then number 8, which is not a source of tax rule. This one's a bit tricky, but it's the International Accounting Standards, because International Accounting Standards is things like your IFRS or your UK GAAP, your accounting rules. That is for accounting, which we do in the second half of this course. That is not anything to do with the tax rules. As opposed to domestic legislation, supranational bodies, international treaties, they all form tax rules. Which is not a benefit of PAYE. That should be again C. It's not to reduce the tax payable for the taxpayer. Number 11, we've got which is not a reason for governments to set deadlines, and that is the bottom one. Setting deadlines is not going to ensure that the correct tax is paid. It's going to make sure people get paid on time. If not, they have penalties, but in terms of paying the right amount, it's not going to help that. And then the last one, which one of the following is a tax authority least likely to have? Which one did we pop for this? A, B, C or D? Yeah, exactly. The power to arrest, A there. And that's because they can't really come into a premises and, cuff you up. But if they suspect that you are tax evading, then they can pass all of that on to people like the National Crime Agency, and then they can come and implement an arrest. But the tax authority themselves don't usually have the power to arrest. Okay, so just a flavour then of exam questions. These are exam standard of questions you could get on chapter 1. Any questions up to there? No? Okay, so I think what we'll do is I think we'll just take a little leg stretch for there, because we have been going for, again, another hour. And then when we come back from a bit of a leg stretch and some fresh air or grabbing a refreshment, we'll make a start on chapter 2, if that's all right with everyone. So if you want to pop back, let's say at 12:10 in 10 minutes, and then we'll do chapter 2. And as I say, we'll have a short session and take lunch at 1. So back in 10 minutes, everybody. Hello everybody, welcome back. So hopefully we've had a nice little leg stretch, just got a bit of fresh air for 10 minutes, and we are ready for chapter 2 to begin. So I'll give you all a moment just to drift back in. So chapter 1 was all about kind of the theory that underpins all of the tax stuff. And then chapter 2, we're basically just going to do a really big deep dive on the income tax and the capital tax computations. So both of them you already know, you've already learned this morning. We've just got a whole chapter where we get to practice it, do lots of calculations and put it into practice. So if we scroll down to the first page, we can see 2 boxes. We're going to look at that pro forma for taxable trading profits, and we're going to look at the pro forma for capital taxes as well. So if we dive straight in, we're going to look at that taxable trading profit one first. And we've just got a little recap here where they've said we start with accounting profit. The aim of the game was to get down to trading profits. In order to get there, we add back disallowable expenses, we deduct exempt income, we add back depreciation, and instead we deduct the taxman's version of depreciation. And then whatever we get for the taxable trading profit, we multiply that by the tax rate percentage given to give us the tax payable. They've just reminded us at the bottom that the tax rules will always be given in the exam. We just need to remember the pro forma. Now, the next page, I'm just going to put a little scribble through because we've already done all of that in chapter 1. It's just basically a giant recap of chapter 1, but we've only just done it, so we can move straight on and do an example. So what we've been asked to do here is calculate the tax payable for the year end. Now, if we read this, it says in the year end, George made an accounting profit of £80,000. Profit included £50,000 of entertaining expenses, which are disallowable for tax purposes. And there was £8,000 of income, which is exempt from taxation. They had no capital items and tax is charged at 25%. So the blue bits that I've highlighted there, they are the rules of country X. They vary for every question, but they've told us specifically that entertaining expenses are disallowable and that we've got some income which is exempt from tax as well. So what we're going to do now is pop all this onto a little bit of a pro forma. So pro forma, we start off with our accounting profits. We then add back any disallowable expenses. We deduct any exempt income. It doesn't look like there's any depreciation in this question. We usually would add back depreciation and deduct the capital allowances, but there isn't that in this question. So that will therefore take us down to the taxable trading profits, and we'll then need to multiply that to get us to the tax payable. So have a go for me, fill this pro forma out, see if you can come up with the tax payable. And when you get to the final answer, pop in the chat panel for me, what did we get for the tax payable? Okay, lots of 19,375. So yeah, that's looking really good. So if we add that in here, we've got the accounting profits. We've deducted the entertaining expenses of 5,500. So we add them back. We have then deducted the exempt income of 8,000. That's taken us to taxable trading profits. And then we have multiplied that by 25% to get to 19,375. So that would be their tax payable. So that one was a really good example, but we haven't looked at depreciation in that example. Whereas we know if we go back to the pro forma before, we actually need to also add back any accounting depreciation and deduct the taxman's version of depreciation. So example 2, we're going to start thinking about that. Now, we're all at different levels in this course. Some people have probably got loads of experience with accounting, some people probably haven't. And that's absolutely fine because next lesson we've got a whole day on accounting. But just to kind of get you up to speed for today, to work out depreciation, there is 2 methods. You can either do depreciation using the straight line method, which is usually called depreciation on cost, or you can calculate depreciation using reducing balance. And the examiner will tell us which one they want us to do. If we use straight line method, then you need to take the cost of an item minus something called the residual value. Now, the residual value is what is the asset's value at the end of its useful life when we've finished using it. And then you divide that by the useful economic life. Sometimes they express this question as a percentage. So you might have to do cost minus residual value and times a percentage instead that the question gives you. Now, they're both straight line, they're just different ways of working it out. So for example, the examiner could say a 10-year useful life, or they could say 10% on cost. Because if it's 10%, it's still 10-year useful life. It's just expressed slightly different. Reducing balance, this one's slightly different. For that, you take the carrying value and you multiply it by the reducing balance percentage that's given to you in the exam. And the carrying value is your cost minus your accumulated depreciation. So if you haven't seen depreciation before, don't panic because we will do it in loads of detail next lesson, but you'll need that calculation or potentially need them to help you with the next couple of questions. So first things first, have a read through, and we've been asked to calculate the accounting depreciation. So if we just have a little look in this example 2, we've been told we've got a year end of December X1. They've got a profit of 50,000. 3,500 of that is entertaining expenses, which are disallowable, and £5,000 worth of income is exempt. Zippy has £70,000 non-current assets, which are required on the 1st of Jan X0, and they are depreciated at 10% on cost. So what that represents there is the accounting depreciation. And if it's depreciation on cost, that's that straight line method that I've just explained. However, the taxman doesn't allow that. Instead, he says you can have tax depreciation allowance at 20% reducing balance instead. So that would be the tax version of depreciation. So what we've been asked for in this question is the accounting depreciation, so that 10% on cost. So just have a little calculation for me, see if you can work out what it would be for the year ending 31st of December X1. And when you've got an answer, pop it into the chat panel for me. What do we have for the accounting depreciation? Okay, looks like we've got a few 7,000s from Maria, Amy, Libby, Myra, Catalina. Yeah, absolutely. I'm going to go with you guys. So we know what the cost is. It's £70,000. We haven't been told that it's got a residual value, which means what is it worth at the end of its useful life? So I'll assume that's 0. We've been told it's 10% per year on cost. So that means every year there will be a £7,000 depreciation charge in the accounting books. Now, taking this one step further, have a go for me at example 3, which is to now calculate the tax depreciation. And they want, what will it be at the 31st of December X1, the current year charge? So have a little look up here. The tax depreciation is 20% reducing balance. And I've popped on the side how you calculate depreciation using reducing balance. Just be careful of your dates on this question because we've acquired this asset at the beginning of 20x0. We want the charge for the year end X1. So you're going to have to work out the carrying value at the end of year 1 first, deduct the depreciation, then calculate the carrying value at the end of year 2, and then it's the depreciation of the carrying value in year 2. So have a go, see how you get on. And when you get an answer for example 3, pop it into the chat panel for me, please. Okay, looks like we've got a lot of answers for 11,200. Absolutely, that's looking like the correct answer. So the tax depreciation, because it's reducing balance, we need to know the carrying value at the end of year 2. But to know that, we need to work out the depreciation in year 1 before we know what the carrying value is in year 2. So step back. Let's say what is going on at the year end, 31st of December, X0. Now then, our asset cost us £70,000. There was no accumulated depreciation because it's the first year of ownership. Multiply that by 20%. That means depreciation in year 1 would have been £14,000. And that means at the end of year 1, the carrying value, the asset did cost 70k. It's been depreciated by 14k. So the asset was now worth £56,000. Then we can say what's happening at the year end, 31st of December X1. So this time, the depreciation, we take the carrying value, which is £56,000, multiply it by 20%, and that takes me to £11,200 charge for that second year. Okay, any questions with that one? So we will cover depreciation a lot more next lesson. Just a little whistle-stop tour of it for today. So the whole purpose of all of this is now we can work out the full taxable trading profits for the year. So I want you to go back to example 2, example 3, use all of that data to fill out the full pro forma. I will write out the pro forma to help you in a second, but see if you can have a go. For example 2, why don't you work that out for the 2 years? for example 2? Yeah, good question. The reason being is if you have straight line depreciation or depreciation on cost, it means that you will have the same depreciation charge each year. It will give you the exactly the same amount, because what you're doing is depreciating it on a straight line basis, which means the same amount every single year, as opposed to reducing balance, which is where it will give you a different depreciation charge each year. And it gives you a different charge using reducing balance because you take the carrying value, and your carrying value is always going to be reducing because you're knocking off an extra year of depreciation. So that's why I didn't do 2 years in the first example. Okay, so I'll write up the pro forma on example 4, but have a bash, see how you get on. Okay, when you've got down to taxable trading profit, pop it in the chat panel for me, please. I've got a couple of answers popping in there. Looks like we're all agreeing at around 44,300. Yeah, I'm going to agree with you guys too. So we've got the 50,000, which was the profit, 3,500 of disallowed, 5,000 for exempt income, 7,000 depreciation, 11,200 for the accounting, the taxman's version of depreciation, which takes me to 44,300. Now, you probably guessed where this is going, but if we just do the next example together, on example 5, they've now said assume tax rate of 30%. What is the tax? Well, we've got 44,300, which you guys have just told me. Multiply that by 30%, and that means this business will have to pay tax of £13,290. Okay, so I've done a full computation there for taxable trading profits. Now, there's just something else we need to consider, because in this example, in example 5, we've been told the tax rate is 30%. So it was just a box standard tax rate, and we could just multiply our profits by that. However, in reality, what sometimes happens is, let's say our year end is the 31st of December. Sometimes when the new tax year starts, which is April, the tax rate may change. So it may be that we were sitting at 20% tax for the first part of the year, and then from April onwards, maybe they increase the tax to 25%. So it might not be just one tax rate across the whole year. There might be multiple tax rates if it changes. So if that happens, like we've got in example 6, we need to do a little bit of prorating. So here they've said assume that it was 28% tax from the 1st of April X0 to the 31st of March X1, and then 30% from the 1st of April X1 to the 31st of March X2. So wherever you've got changes, I think the easiest thing to do is draw yourselves out a little bit of a timeline. So we've got from the 1st of April X0 to the 31st of March X1. During that time, it is 28%. And then from the 1st of April X0 to the 31st of March X2, it has now increased to 30%. If we now mark on where our financial year is, our financial year is from the 1st of January X1 up until the 31st of December X1. So you can see that our financial accounting year spans this change. So what we need to do now is figure out how many months are in the first tax rate and how many months are in the second tax rate. So from the 1st of January to the 31st of March, it was 28%. So that is 3 months. Whereas from the 1st of April X1 to the year end, that is 9 months, and that's going to be at 30% taxation. So bearing that in mind, have a go for me. We know our taxable profit was 44,300. Have a go at calculating what you think the new tax would be for the year. And when you get an answer, if you want to pop it in the chat panel for me, please. Okay, so we've got a few people going for £13,068.50. Yeah, absolutely. So we've got that 44,300. It's going to hit tax at 28% for 3 months of the year. And then that 44,300 is going to hit tax at 30% for the remaining 9 months of the year. So if we then add them up together, that's 13,068.50. Okay, so what I want to do now, if anyone's got any questions, give me a shout. But what I want to do is have a go at a question from the exam kit. So I'm just going to pop it on the screen. If you want to find it in your books, you're welcome to. It's question 29, but it's also on the screen. We've been asked here to calculate the tax payable for the year. Now, I'm going to set up a poll so I know when you guys have answered. So if you pop your answer into the poll when you get there, you'll need to probably, on a bit of scrap paper, draw out the pro forma so that you know what the tax payable is. Okay, I've got 8 responses on the poll. Just skips up to 11. So I'll give you another kind of 10 seconds or so, and then we'll have a run through. Okay, I've got about 50% of responses there. So I'm going to end the poll and share the results. So it looks like the majority of us who answered there have gone for D, and D was the correct answer. I'll talk about why and I'll draw the pro forma up with you now. So we start off with our profits, which the question said was £860,000. We then need to add back any disallowable expenses, and they said they've got £15,000 of development costs which are disallowed. So 15,000 goes in. We then would add back any accounting depreciation in this question. And it was a bit of a nicer question than the one in our books because they've already calculated depreciation and said that it was 42,000. So that can go in. But then instead we get to deduct the tax depreciation. And they said the tax depreciation was 51,000. So if we strip that out, that takes me down to 866,000. Tax is at a rate of 25%. So if we multiply that by 25%, we get 216,500, which is D. So exam standard question there. They can sometimes be a little bit trickier if they don't calculate depreciation and we have to do it. But that is straight from the exam kit. So that is exam standard. All right then, so that is an exam question. Let's go back into the Kaplan book because there's one more thing on this taxable trading profit pro forma that we need to talk about before we've completely finished with the taxable trading profits. And that is something called balancing allowance and balancing charges. Now, if we think of the accounting for if you want to calculate in the accounting world a gain or loss on the disposal of an asset, you would take the proceeds minus the carrying value of an asset, and that would give you a gain or loss on disposal. Now, with that gain or loss on disposal, that would feed through and go into your accounting profits. However, can anybody spot anything wrong with that? Why might our tax authorities not like that gain or loss on disposal going into accounting profit? Yeah, so if it was a loss on disposal, it'd reduce the value. If it was a gain on disposal, it would increase the profits. But anything specific about the calculation itself? Yeah, it's going to reduce the taxable amount if it was a loss, but the calculation itself, let's think about this part here. Proceeds minus carrying value. What goes into carrying value that the taxman doesn't like? Yes, bingo, absolutely. The depreciation. The taxman doesn't like depreciation. And if we think of a carrying value, that is the cost of an asset minus any accumulated depreciation. And that's a red flag. They're not happy with that. So what's going to happen, the last adjustment in our pro forma, is any gain or loss on disposal that feeds through into accounting profits, we need to remove it. Taxman doesn't like it. It's got accumulated depreciation that's impacted in there. He's not happy with it. So we're going to remove that. But it's not the end of the game because instead what's going to happen is it's going to get replaced. And the thing that it's replaced with is a balancing allowance or a balancing charge, which is the taxman's version of a gain or loss on disposal. So if we have a look on the left over here, you would take the proceeds, so that's still fine, you can take the sale proceeds, But rather than deducting the carrying value, you now are going to deduct something called the tax written down value. And that is the tax version of the carrying value. It's much more black and white, it's much more rules based. So that's why the tax authorities now like it. We've removed that element of subjectivity. And then with that gain or loss on disposal, it's not called a gain or loss on disposal anymore because it's the tax version. So the tax version will be called a balancing charge if it is positive, i.e. a gain, or it would be called a balancing allowance if it is negative, i.e. a loss. So they've just mentioned that at the bottom, the difference between them. If the proceeds are higher than the tax written down value, it's a balancing charge. If the proceeds are less than the tax written down value, it's a balancing allowance. But they've clearly explained it here for you. So on the next page, we've now got a full, complete pro forma with everything that you might need in this taxable trading profits. So we started off at the top with accounting profit, which we've already dealt with. We knew that. We add back disallowable expenses. We already knew that. We deduct any exempt income. We already knew that. We add back accounting depreciation. That's fine. We already knew that. Instead, I don't know why they've put it down here, but instead we are allowed to deduct the tax depreciation allowance. We know about that. And then the new bits is we are now going to add back if we make a loss on disposal of an asset, and we're going to deduct if we've made a profit on disposal of an asset. And instead, what we're going to do is replace it with a balancing allowance or balancing charge. So I recommend writing these in. I don't know why they're not on here already. But instead, you are now going to add back in if they have a balancing charge. Or if from that calculation on the previous page, you got a balancing allowance, you are going to deduct it because that's the taxman's version of a loss on disposal. You'd net that off, and then that is what would then take you to your taxable trading profits, which you'd then take and multiply by the tax rate. So that's got everything in there that you might possibly need. So accounting gain or losses on disposal, remove them. So add it back or deduct it. And then instead it's replaced with this balancing allowance or balancing charge. And how you calculate that balancing allowance or charge is given to you on that previous page. It's here. It's that proceeds minus the tax written down value, which will be given, or they will explain how to calculate it. The rules will be given. Okay, any questions on that one? Now, we've probably got just enough time actually to have a look at what happens now if we don't make a taxable trading profit and instead in the year from our business operations, we make a taxable trading loss. So over on the next page, they've said when you make a trading loss, what happens? Well, we say that the tax payable in that year will be zero. You don't owe any tax. You don't have to pay any tax over because you've made a loss. But it doesn't end there, because what you can then do is you could claim loss relief. Now, loss relief, there is 4 different types of loss relief that you could implement. Number one, it depends on the business, the country, by the way, they're different for every country. But number one is you might be able to carry a loss forwards against future profits of the same trade. So if I give you an example, we'll say number one up here. Let's say current year, I've made a loss of $100. Let's say next year, I make a profit of $150. What I could do is with that loss this year, I could carry it forwards, deduct it from next year's profit, and that means next year my taxable profit would only actually be $50, not $150. So you could carry it forwards, knock it off against future profits. Option number 2 is you could also do the opposite. You could carry the loss backwards against previous periods. But obviously that means if you're carrying it backwards, you've already paid tax in the past. So that means you can now get a bit of an IOU. In other words, you can get a tax refund. So if I show you an example of that, number 2, let's say in the current year, we've made a loss of $100. In the prior year, let's say we made a profit of $200. What we could do is say, right, well, that loss, let's carry it backwards, knock it off against last year's profits, which means last year we only actually made $100. So the excess tax that we paid, we can get a refund. So you're getting a refund for that excess tax that's been paid. Now, whilst we're on carrying losses backwards, and I'll come back to the other 2 boxes in a second, but just underneath, they've got a little bit of a write-up about what happens on cessation of a business. Cessation basically means closure of a business. So if you're closing down the business and you've made a loss this year, then option 1, which was carrying the loss forwards, you can't do because you're closing down the business. There's not going to be any future profits. So if you're closing, then what you can do is carry the loss backwards against previous periods. But what some countries allow is when you're carrying that loss back against things that have happened in the past, previous periods, you could have terminal loss relief, which means you can carry that loss back up to 3 years in the past, as opposed to standard, which most countries is usually 1 or 2 years back. In the UK, if you're closing down, you can carry it back 3 years because you don't have that option of taking it forwards anymore because you're closing the business. So that's what that point means. They've said they'll tell you in the question if that's allowed in the country that they've created. So just keep an eye out if they allow that or not. We've then got option number 3. If you've made a loss, you could offset that loss against the group company. Now, for this one, what we might have is a parent at the top, and it might have various different subsidiaries. So we'll say subsidiary number 1, subsidiary number 2, subsidiary number 3. So we don't do groups in F1. You do a little bit of groups in F2. But let's say a parent, someone like Nestle, and they own various companies. Let's say they have Aero, Smarties, and Kit Kat. Now, what might happen is in the year, Aero made a profit of $100, Smarties made a profit of $50, but actually Kit Kat made a loss of $20. So what could happen with that loss that Kit Kat's made is they could actually sacrifice that and give it to one of the other subsidiaries. Now, it's up to the discretion of the parent which subsidiary they want to give it to or how much they want to allocate. They could do a 50-50 split. They could give it all to one sub. Doesn't really matter. Let's assume that they give it all to Smarties. So if they give all of that loss to Smarties, that means Smarties actually only now makes a taxable profit of $30 because they have got some of the loss from Kit Kat. So that's what it means by offsetting a loss against a group company, against a different subsidiary. And then the last one, number 4, is if you offset losses against capital gains in the same period. Now, this one is very, very rare. I never see this because usually they want to keep capital gains completely separate from taxable gains and losses from trade. So basically it's saying here that if maybe you made a loss from trade, you could offset that against a gain from the sale of an asset. But it's very, very rare. They don't usually do that. They keep them quite separate. So let's have a go at putting these loss reliefs into practice because it all depends on what is allowed in that country. So have a quick read for me of example number 7. I'm going to help you, so don't worry, but just have a read of example 7 to begin with. Okay, so we've been told here that the rules in this country are that trading losses can be carried back and set off against the previous year. If you've still got some losses left, any unrelieved losses can then go forwards. And we've been given some information here about loser for years 1 through to year 4. So I'm going to say at the side, what is taxable? Because that's what they've asked me in the question. What is the taxable profits each year? So if we look firstly at year 2, I can see a whopping great big loss of $45,000. So the rules are, firstly, it needs to go backwards. So we can carry back some of that loss, but the maximum that can go back is restricted to the profit. So we made 20,000 last year, so we can carry back £20,000 of the loss. So that means taxable in year 1 will be 0 because they did make 20,000, but we've utilised £20,000 of the loss. Then we've still got some loss left. So what we're now allowed to do is unrelieved losses can then go forwards. So a little bit of that can then come forwards into next year. Next year we made a £19,000 profit. So we'll relieve £19,000 of the loss. So in year 2, obviously that was 0. And then in year 3, they did have £19,000, but we have utilised £19,000 of the loss. And then the last bit, in year 4, we did have a £45,000 loss. 20k went last year, 19k went forwards a year. So the amount of unrelieved loss that's left is we've got £6,000 left. So if we did have a £25,000 profit, we are carrying forwards the remaining amount of 6,000. That means £19,000 is taxable in year 4. So that would be your response there for how much is taxable in each year. 0 in year 1, 0 in year 2, 0 in year 3, but 19,000 in year 4. Okay, have a go for me then at example 8. You can try one of these on your own. It's exactly the same. I probably recommend setting it up in a similar way by just popping on a little column that says what is taxable. And if you can do that for me, and give me a thumbs up in the chat when you've finished. Okay, that seems to be pretty quick. Looks like lots of people have managed to have a go at this already. So if we have a quick look, it says losses can be carried back. Any unrelieved losses can then go forward. So make sure you always still read the rules because they're not always the same. So that means in year 1, what did we get as taxable? None? Yeah, absolutely. Year 2 is going to be 0 as well because obviously they've made a loss. 25,000 of that went backwards. A little bit of that can go forward, so 15,000 goes forwards, which means 0 is taxable. And then what about year 4? What did we get there? Yeah, lots of 30,000s taxable too. And that's because we did have £35,000, but we have utilised the remaining £5,000 of that £45,000 loss. Great stuff. So any questions on taxable trading profits or losses? Question, yeah, it says it can be set against the first available profits. Yeah, so what that means is where we've got the loss of £45,000, we've obviously utilised £25,000 of it last year, which means there's £30,000 left. Then with that £30,000 left, you have to go to the next year. So you have to set it against the 15k first. You can't take that 30,000 and say, oh, well, let's take all the 30,000 to year 4. You're not allowed to do that. You have to do it chronologically. That's what it means. Okay, any other questions? Yes, but can I then go on to relieve? Yeah, exactly. So it just means against the first available profits. And then if you've still got loss left, then it goes to kind of the next year as well. Yeah, it's a bit weird, the wording of it, But just by first available trading profits, it means whatever profits are coming in first, and it continues to be those until it's all been used up. Okay, any other questions? So I think now will be a good time for our lunch. We are 1 minute to 1. And after lunch, we can move on to the other computation, which was the capital taxes. So we're making quite good headroom here. So if we take our lunch, pop back at 2 o'clock for me. And any questions that come up over lunch, just give me a message and I'll answer them when we get back from lunch. Thanks, everybody. Hello, everybody. Welcome back from lunch. Hi, Caitlin. Hi, Kimberly. Welcome back, everybody on the chat. Nice to see you all again. Hopefully you had a nice lunch break. Did anybody get up to anything nice over lunch? Any exciting lunchtime activities? I sat out in the garden, which is nice. It's nice to have a bit of sunshine, isn't it? Anybody else do anything nice? Oh, that sounds nice. Had a walk down the canal, a walk in the sun. Yeah, the washing out. Ours is definitely swinging out in the garden. Oh, lots of walking in the sunshines. Sounds great. I've broken my leg at the moment, so I can't walk. I basically just hobble around on crutches. So I'm very jealous of all those who have managed to go for a nice walk in the sun. Course upon a bit of sleep. Fair enough. It's nearly Friday. We're nearly there. All right, so looks like we've got lots of us back on the chat, which is great. We will pick up where we left off. So we've had a look in this chapter at the taxable profit calculation and the pro forma for that. Now we're going to look at the capital taxes, which is the second pro forma that you learnt in chapter 1. Now we said at the most simple level for capital gains tax, you can look at the proceeds minus the cost to get you to your capital gain. But at F1, that is just a bit too simplistic. So instead, we learned this pro forma and we said you take the proceeds, which would be how much you've received for the sale, and you would net off any incidental costs to sell today, which were things like estate agent fees, for example. That gets us down to our net proceeds, and then we deduct off from that our historical costs, which is costs to originally acquire the asset. So the original cost of the asset, cost to buy, such as solicitor fees, stamp duty, land tax, enhancement costs, we said they're allowed, but repairs aren't. And then indexation allowance is allowed to be deducted. And that's calculated by taking the percentage that the examiner gives us, multiplied by all of those historical costs. So not any costs that have been incurred today to sell, but all the ones when we first bought the asset. That then gets us down to our chargeable gain, which we can then multiply by the appropriate tax rate. So taking this pro forma, have a go for me at example 9. So I'll write the pro forma out with you, but it's the one we've just recapped. Have a go and we'll have a debrief in about a minute's time. And when you get down to an answer for the taxable gain, if you can pop it into the chat panel for me, please, what you got. Okay, so quite a lot of £84,500. Yeah, that's looking good to me. So proceeds, they said, were 150,000. Incidental cost to sell were that £2,000. That takes me down to a net proceeds of 148,000. We've got incidental cost to buy being the £1,500 legal fees, the original cost of the asset being the £50,000, and then enhancements is the £12,000, which were the extension. In terms of the violent storm and the roof, that is not allowed to be deducted. It's not an allowable deduction. So that takes us down to £84,500. So that is a full chargeable gain calculation. Now, just on the next page, they've said, what is the capital tax to be paid on disposal? This one is a more simplistic example because all we have is the cost of the asset and the sale proceeds and then the tax percentage. So if we were to take those sale proceeds, using the more basic calculation, we can strip out that original cost. Takes us down to a net gain on the sale of the asset of £30,000. They've asked us for tax, so this time we can take it one step further, multiply it by 30%, and that means this company would have to pay £9,000 because they have disposed of an asset and it was a chargeable gain. So we're going to keep building these questions up. The next question we've got is a little bit of an example on indexation and how indexation could be claimed. So I'll let you have a read of this one. And when you think you know what the indexation allowance is, pop it into the chat panel for me. Okay, starting to get a couple of answers in there. Looks like majority of us are going for £6,000. Let's have a little look then. So indexation is any historical costs, and we've been told they bought an asset for £20,000. The asset was sold for £50,000. So that historical cost of acquisition of 20k can be indexed by the 30%. So that would give us £6,000. So with that £6,000, that is their allowance for inflation. You would take that and knock it off of the pro forma. It's an allowable deduction. So bringing all of this kind of together, we've been asked on the next example to have a go at calculating the capital tax to be paid on disposal, looking at example 10 and example 11. So I'll give you a minute just to have a go at that one. And again, if you can pop your answers into the chat panel when you get the answer, then we'll have a check. Okay, getting a lot of answers in there for 7,200. Again, looking good to me. So we've got the sale proceeds, which were £50,000. We've got the cost of the assets, which was £20,000. That takes us to a chargeable gain of 30, but this time we have that indexation allowance. And we calculated it before at £6,000. Net that off, that means our final chargeable gain is 24,000. Tax is at 30%, so that takes us to £7,200. Great stuff. Any questions on that then? So we've looked at a computation, a more simple one, a more advanced one. We're going to look at one in the exam kit now. So if you do have questions, now is a good time to ask. If not, if you could grab your exam kits for me, please. And we're going to have a go at question 49. So in question 49, you might want to, again, get a bit of scrap paper because you need to work out that capital gains tax computation to figure out the tax that is due. I'm going to set a poll up. So if I... Oh, might not let me, actually. The button seems to have gone missing. Yeah, for some reason my polls have disappeared. So I'll just give you kind of 2 minutes. Don't pop your answers into the chat panel yet. I'll ask you for the answers all at the same time when you've had a chance to have a go. Okay, so if you have managed to get to an answer, pop it in the chat panel for me now. A, B, C, or D. What did we get? Okay, looks like we've got lots and lots of people going for A there. I am going to agree with you guys and say that it is A. So if we have a look at why that is the case, I'm just going to unfreeze my screen. I've wrote the pro forma out. We've got the sale proceeds, which was 1.2 million. But then we had some incidental costs to sell, being those £9,000. So in terms of the net proceeds, that takes me to 1,191,000. We've then got any incidental costs to buy, which they said are £5,000. And the cost of the asset itself, which was £600,000. Indexation allowance, that is for any historical costs. Now, the historical costs are these ones here. So historical costs in total are 605,000. So if we take 605,000, indexation is 60%. That's going to take me to 363,000. Net those off, and that gives us a chargeable gain of 223,000. At 25% tax, that means we've got 55,750 as the tax that is due. So that's as hard as capital gains tax computations can get, and we've done an exam standard question there out of the exam kit. Any questions on capital gains tax? How do the dates relate for the indexation? Yeah, so the indexation in this case, they've said it's 60% indexation if the cost has been incurred between the 1st of September X4 to the 31st of August Y1. If you look at when our costs have been incurred, they are in the 1st of September X4. So as long as any of our costs are between those dates, then we would use 60% indexation. Now, the reason they've given us the dates is because sometimes you get two indexation rates. They might say it's 60% if the costs are incurred from the 1st of September X4 to the 1st of September X5, and then after that it's 70% indexation. So then you'd have to look at when were the costs actually incurred and use the appropriate indexation rate. So that's what that means with the dates. But as long as you follow the dates in the question and look at when the expenditure was incurred, you just use that appropriate indexation rate. No problem? Okay, so if we go back to the Kaplan book now, we've looked at what happens if you make a capital gain. Same thing as we kind of saw earlier with trading gains, you can also make a capital loss. So capital losses, these are the same as trading losses, in that you might be able to carry it forwards, might be able to carry it backwards, might be able to offset it against trading income, but the rule is you need to just look at what the regulations are in that country, because it's different for every country. So you need to read the question. So let's have a look at an example in the Kaplan book. They have said that capital losses can be offset against capital gains in the same year. So that means if they've sold two assets, one made a gain, one made a loss, they can net them off, but only kind of capital items. Unrelieved capital losses cannot be carried backwards this time in this question. However, they can go forwards. So have a go at seeing what is taxable for years 1 through to years 4 for this taxable gains for this business. Okay, let's have a little look at what's taxable here then. So this time we've been told capital losses cannot go backwards. So that year 1, £3,000 gain is going to remain. Year 2, they made a loss, so that's going to be 0. And then any unrelieved losses can go forwards. So anything can go forwards to year 3. So that's going to be £2,500. That will make that 0. And then the remaining, which is £1,500 left, will go into year 4. £3,000 minus 1,500 means we've got 1,500 left that is taxable. Okay, so what we're going to do now, we're going to do one more of these loss questions, but this time we're going to merge together in one question trading losses and capital losses. So it's kind of killing two birds with one stone. It's in your exam kit. Again, I'll show it on the screen, and it's question 45. So I'm just going to start off by letting you have a read first of question 45, and then I'm going to talk to you about approach and how to tackle this, because it's definitely a skill to be doing these questions. But just have a read for me. So you probably read that and think, sounds like a riddle. There's a lot going on in there. So what I recommend doing is if you get a question like this, just breaking down the rules to see exactly what's going on. So they're starting off with trading losses and they're saying that they can be carried back and can go back against the last 12 months. Any unrelieved losses can then go forwards, but trading losses can't be offset against capital gains. So there's no mix and match between trading losses and capital losses. Capital losses, they've said they should be set off against capital gains in the same tax year. But then if there is any unrelieved losses, they cannot go backwards, but they can go forwards. So what I recommend doing is just to kind of decode that, is just write the rules out in kind of really simple terms. So trading losses, they've said for those, they can go backwards and they can go forwards. Capital losses, they said that they can only be used in the current year against kind of a capital gain in the current year, and they can go forwards, so they cannot go backwards. And then they've also said that there is no mix and match. So you can't mix and match a trade loss or a trade gain with a capital loss or a capital gain. So now that you've summarised the rules a little bit more simply, have a go at doing the trading profits and or losses and the capital gains and losses. And they want you to just fill out the table below for what is taxable in each of the years. How can you offset in the same tax year? Yeah, so it means with the capital gains and losses that if you've sold two assets and one's made a gain of £100, one's made a loss of £20, then you can net them off together and say, well, the net capital gain is 80 because you've net them off. So that's what it means by using it in the current year. Okay, let's have a little look then. So let's do the taxable profits first. What did we get for year one? What would be taxable in year one? Yep, lots of zeros, absolutely. And that's because with the trading loss, it can go backwards. So out of that 90,000, we'll be sending 50,000 of it backwards. Year two will also be zero because they've obviously made a loss. What about year three? Yep, absolutely, lots of zeros. That's because we can go forwards, so I'll utilise 30,000. And what about year four? Yeah, lots of 60,000s, spot on. And that's because the unrelieved loss, which is £10,000 left, goes into year four. Right, capital gains and losses next. What did we get in year one for the taxable gain? Yeah, so different here, £6,000 because they've said capital losses cannot go backwards. So that means it remains at that £6,000. They made a loss in year two, so that's zero. What about year three? Yeah, absolutely. It's going to be zero because it can go forwards. So they'll offset £5,000 in year three. And then year four, we can offset the remaining amount of 3,000, which absolutely those in the chat have said it goes down to 3,000. So a question that initially seemed really complex actually becomes quite simple if you just break it down and think, what are the rules of this country, and then apply them one by one. So just read the question carefully and you should be okay with that. Let me know if you have any questions or issues, but if not, we will jump back into our Kaplan book. So there's just one last little bit in this chapter. And it's a little bit on groups. Now, you don't really do groups in F1. We'd save groups for F2. You do some kind of group accounting, which is quite fancy. But when we're talking about tax, we do just skim the surface a little bit with groups. Mainly just the idea that we've talked about with loss relief, it might be within the group. And then there's a couple of notes here on things like appropriation of profits and what is a group. So a group exists when one entity controls another entity, which we talked about earlier, the context of Nestle, and I said it might be Nestle owns other kind of subsidiaries beneath it, like KitKat, Aero, Smarties. And if you own more than 50% of the shares, we say that they're a subsidiary and therefore they're part of this group. They're part of the umbrella of our company. Now, this next little bit is about appropriations of profit. Because what happens with a lot of businesses, including groups, is when they make a profit, they often then distribute that profit. And how they distribute it is in the form of dividends. So they distribute it by paying dividends. So we just need to think of for a second what happens with dividends and taxation. So you don't have to draw this out, you can just listen. But where we have maybe a statement of profit or loss, we have at the top things like our revenue. We'd knock off our cost of sales. That gets us down to our gross profit. We might then have a series of operating expenses. That gets me down to my operating profits. I might then have some finance costs, interest, income, that kind of stuff. We'll then have some taxation. And we've then got our profit after tax. What then happens with that profit after tax is two things. They either keep the profit within the business, which is what is then referred to as retained earnings, or they pay that profit out to their shareholders as a dividend payment. And if they do choose that dividend route and they pay it out to their shareholders, then the shareholders are going to be really happy because they receive some money, but those shareholders will get taxed on that dividend income because it's seen as part of their income. So it's taxed at that 20, 40, 45% rate, depending on how much money in total the shareholder earns. So that creates a bit of a problem because where we've got dividends, they were taxed when they were in the business. So the profit's already been taxed because it's profit after tax that's distributed. But then it's also taxed again when the shareholder receives that money. So really that dividend or that appropriation of profit has been taxed twice. It's a problem with kind of double tax here. So what we need to consider is how can we overcome that problem that profits that get distributed are taxed twice? And that's what our notes are on the left. So they've said we've got dividends. They are given out of taxable trading profits, and it's obviously taxable. Now, the dividend is then distributed to shareholders, and the shareholder is then taxed as part of their personal income, which I've just explained to you. So that creates a problem because dividends are usually taxed twice. So there is 4 different systems to try and overcome this problem of double tax of dividends. The first one is a classical system, and the classical system just says, tough, so what? It's taxed twice. That's the way it is. Because what the classical system argues is that the shareholder is seen as independent from the entity. So the profits are taxed when the entity earns them, and then this appropriation of profit is also taxed when the shareholder receives it. And they're seen as separate people, so that's the way it is. Not very fair. So a different system is an imputational system, which is where a shareholder receives a tax credit equal to the income tax that's already been paid by the business. So in other words, the shareholder will receive a bit of a refund for any of the tax that they end up paying because they've got the appropriation of profit. And that's because the profits have already been taxed in the business. So the shareholder, they get a little bit of a refund for any tax that's taken. Then a partial imputational system is where they get a little bit of tax credit, but only for part of the income tax that's been paid by the business. And this is what we have in the UK. It's changed now. It used to be that in the UK, you don't get taxed on the first £1,000 of dividend income, but I think it's gone down now. I think it's £500 now. So you don't get taxed on the first £500 of dividend income, and then after that, it is taxed. And then the last one is a split rate system. And a split rate system distinguishes between what profit is distributed to the shareholders versus what profit is retained, and it charges a lower income tax on the part that's being distributed because it knows that that is going to get taxed on the shareholder anyway. So if I go back to my diagram over here, when you've got that profit after tax, it says how much you're going to keep, how much you're going to pay out as a dividend, and the bit that you're paying out as a dividend, that part will get taxed at a lower rate when working out the business's tax, as opposed to retained earnings, which will get charged tax at the normal rate because that's not getting distributed. So that's what split rate system means. Okay, so any questions on this chapter? Let me know. It was a little bit more practical, chapter 2. So the main things numerically that you'll get tested on is what we've seen, looking at some computations, mainly the 2 pro formas of the capital gains tax and the total taxable profits as well. Okay, so what we're going to move on to next is a little bit of international taxation. So if you could turn to chapter 3 for me. This is the last chapter for tax. We'll see how far we get. We might get through this before break. And then after break, we're going to quickly skim through chapter 5 and 6, which are kind of easy win chapters. And chapter 4 is for homework. So international taxation. This is a problem because businesses trade overseas. And if you trade overseas, you might end up paying tax on your overseas profits to overseas countries, but you might still be liable to pay tax in the UK. So you might end up with things like double taxation because you're trading overseas and you're a UK resident, so you might end up paying tax twice. So we're going to have a look in this chapter of what you can do to overcome that. We're also going to look at ways that you can go overseas, so branches versus subsidiaries. So a little bit of kind of general business in here as well. So I'm just going to get stuck straight in, to be honest, with this first page of corporate residence. So when a company decides to kind of start trading, maybe they trade a little bit overseas, then they will pay taxation on their worldwide income to the country in which they are deemed to be a resident. So what that means is if I set up my own business and I say that it is a resident in the UK, maybe it was formed in the UK, my main board of directors are in the UK, when I go and trade and maybe sell some goods in Germany, even though I'm selling some goods in Germany, I will still be liable to pay tax to the UK government on any sales that I make in Germany. The reason being is my company has an identity, it has a corporate residency in the UK. So it's important to consider, where is a company a resident? So we say that a company is a resident in their place of incorporation. So incorporation just means kind of where were they created, where were they developed, maybe where were they kind of registered. Or we can look at their residency as being the place of control and central management. So this means, where are the directors? Where do they have their board meetings, where all those key decisions are made? Yeah, it's the same thing, domicile. It's the same as your residency. Where are you deemed to be a domicile or a resident? So we need to determine where they are a resident, because that's where they'll pay tax on their global profits, on their global income. Now, that creates a bit of a problem, because for some businesses, it might not be as clear cut as this, because maybe they're incorporated in one country, but maybe their central management and control is in a different country. So sometimes it's a little bit difficult to work out the residency, and we'll come back to that argument at the end of the chapter. We've got like a little write-up about what happens when they're incorporated in one but managed in another country. But for now, bear in mind that this is how we determine the residency. Have a go for me at example 1, which are all about corporate residency questions. Okay, let's have a little run through some of these. So they definitely get you thinking. They're like little riddles. So the first one, which is ALDA, a company which is not centrally managed and controlled in the UK, will never be liable for UK corporation tax on worldwide profits. What do we think about that? True or false? Yeah, lots of falses there. And the reason being is even though they're not managed and controlled in the UK, they could have been incorporated in the UK. The next one, Beach, a company which is not incorporated in the UK, will never be liable for UK corporation tax on worldwide profits. What do we think of that one? Okay, so dominant answer there is false. There's a couple of truths. The answer there is false. This is a different company. This is Beach. So it's kind of the opposite to Alder. They are not incorporated, but they could have central management and control in the UK. All right, the next one, we've now got Maple. They are incorporated in the UK, but not centrally managed and controlled in the UK, are still liable for UK corporation tax. What do we think to that one? True or false? Yeah, absolutely. They hit one of those two things, incorporated or centrally managed and controlled, while they are incorporated. So they will be liable for UK tax. And Rowan, what do we think about them? They are not incorporated in the UK. They are not centrally managed and controlled in the UK. Still liable for UK tax? Yeah, absolutely. That's going to be false there because it doesn't hit either one of those two requirements. So we'll come back to this idea of corporate residency at the end of the chapter as to what happens when you're centrally managed and controlled in one, incorporated in the other, and where are you actually a resident. We'll come back to that. But for now, we'll park that there and we're going to take a look at something else, which is the concept of double taxation. Now, we've just talked about double taxation in the context of dividend payments to shareholders. This is something different. This is double taxation when you are trading overseas. So let's say that you are a company that has a UK residency, but you have decided that you are going to start trading in Germany. So you're selling some goods overseas in Germany. Maybe you are setting up a bit of a branch over there. Now, that creates a bit of a problem because on any of the income that you make in Germany, it's going to be liable to UK taxation. The reason being is because you are a resident in the UK. So even though it wasn't earned in the UK, you're still going to be liable to tax in the UK because you're a resident. But you've earned this money in Germany. So chances are Germany might want a bite of the cherry and they might want to take some money off you as well. So you could end up paying tax in Germany as well. So you can start to see a bit of a problem here because it might get taxed in two places. And that's what we would call double taxation because of international trade. So if we have a look at the notes, it says a company could be subject to double tax because they may earn income in X even though they are a resident in country Y. If this is the case, double tax relief is often available. So you can get some sort of relief to compensate you for this double tax problem. Now, there's three types of double tax relief. The main one that we tend to see in reality is the middle one, tax credit, but we'll talk through them all. So the first one is called exemption. And this is where the countries agree on certain types of income which shall be exempt or partially exempt in one country or the other. So this is often referred to as a treaty. And it might be where the UK and Germany have some sort of agreement, a treaty in place that says, do you know what, if a UK resident comes and earns money in Germany, we as the German government won't take any tax off you because we know that they're going to get taxed in the UK. So that's our exemption, that's our treaty, we won't tax them here. The other option is the tax credit system. And this is where we know it gets taxed in two countries. So you'll get a credit, a little bit of like a refund in one of the countries, and the relief is restricted to the lower of the taxes. So if you've paid £100 tax in Germany, you've paid £150 tax in the UK, then you might get a little bit of credit, a bit of relief. When you're paying your UK tax, they'll knock off the £100 that you've already paid in Germany because it's a tax relief, a tax credit. The other one is deduction. Bit strange, this is probably the rarest one. So this one was the most common. This one is rare. And this is where tax relief is gained by deducting foreign tax from foreign income, and then only a net amount is subject to taxation. So yes, you might be selling goods in Germany, but if you're also making purchases in Germany, then they'll net off the income and expense and you'll just pay tax on the net amount. So awareness of a double tax relief is all you need to know. They actually changed the F1 syllabus last year, which I thought was a bit of a shame because we used to actually calculate the tax credit method and get our calculators out, which I enjoyed, but not many students did. So it's probably good news for you that you don't have calculations on that anymore. Just an awareness of what they mean is fine. Okay, so next page is looking at how we might go overseas. So we might want to go and trade in Germany, different methods and ways of doing that. And two you need to be aware of. You could choose to go overseas as a subsidiary, or you could choose to go overseas as a branch. Now, if you're going overseas as a subsidiary, I want you to think this as you're setting up kind of a completely separate company. You're setting up an overseas company that has its own identity, it's got its own risks, its own rewards. You're kind of setting up a whole new venture overseas. As opposed to a branch, which I want you to see as an extension of the home business. So it's almost like it's still the same company, they're just setting up a bit of an office, or they're setting up an overseas presence. So I think of this one as like a bank branch. It's a bit like Santander. They have lots of banks in the UK, and they've decided they want to go and have a bit of a presence in Germany. So instead of setting up an entire new business model in Germany, they just open up a branch. They open up a bank branch, a shop in Germany that says Santander, and you can withdraw your money from it. As opposed to a subsidiary, which is a whole new venture that they're going to create. So if we look at the first one, a subsidiary, kind of thinking of a separate company, that's when that overseas business is seen as a completely separate entity for tax purposes. So what that means is the holding company is the parent company back at home. All that home parent will do is pay tax on any of the dividends that they receive from this overseas subsidiary. Doesn't matter what profits or what income that overseas subsidiary makes, the UK, you're only going to pay tax on the dividends that they send back home to the parent. What that means is loss relief is not available for the group. Earlier on, we said loss relief might be available. The subsidiaries could sacrifice their losses to the other members like KitKat to Aero. You can't do that if you set up an overseas subsidiary because they are seen as being their own separate company outside of the group, and therefore they are paying tax under a completely different tax regime. This overseas subsidiary also can't claim the same tax depreciation, and if there's any assets transferred between the parent and this overseas subsidiary, it could result in capital gains tax because they're seen as a completely different separate entity that's operating overseas. That's as opposed to if you was to set up something like your bank branch and you're just setting up an office overseas for people to withdraw money from. In this case, the branch is treated as an extension of the UK activity. So what that means is any profit the bank branch makes overseas, the parent or the UK company will be subject to taxation for that overseas branch activity. All of it, any profits that that branch makes will be taxed in the UK. So it's not just dividends this time, it's everything they make overseas. But it does mean that loss relief is available because they're seen as still being part of the group. They're seen as being part of the same company. The branch can also claim the same tax depreciation on assets. And if they transfer any assets between the home businesses and the overseas branch, then they can do that at a no gain, no loss rate. They can freely move assets between the branch and this home business because they're seen as part of the same company, the same business. I'm sorry, weird question. If a parent company has two separate subsidiaries, both in the UK, can they claim relief for the sister companies too, UK to UK? Yeah, absolutely. So if you've got, even if it was like, let's say up here, a subsidiary, you've got the parent, you've got one UK sub, you've got another UK sub, and then you've got an overseas subsidiary. Basically, you need to think of this one as kind of like the black sheep. That one isn't involved in the group anymore, it's on its own. But the UK subsidiaries, they can still transfer loss relief with each other because they're both in the UK. It's just that overseas sub that is seen as someone who's now separate and can't enjoy this loss relief or asset transference. Whereas if they were a branch, then they could. How common is double taxation in real life for UK businesses? It's actually really common, especially this one here, the tax credit system. So what happens, to say it most simply, because obviously you don't get tested on the calculations anymore, but to say it most simply, let's say you were a UK resident trading in Germany, for example, and you made some profits and you paid £50 tax to Germany. Then in the UK, maybe they say that you owe £100 tax because maybe our tax is higher. What they would do is knock off the £50 that you've already paid overseas and say, right, okay, well in the UK, you just owe us 50, which is the difference. So that's really, really common in real life that businesses tend to do. Sometimes there is exemptions. A lot of the exemption stuff, there is a lot of things like the EU as well. Like if we were part of the EU still, you can transfer goods and services for free without import tariffs and duties, but obviously now we're not in that. There's a lot of other taxations that we face. Okay, so let's have a look. I work in the airline catering industry. Well, that sounds very exciting. You should see how complicated that is. You need to know where you are exactly. Yeah, I can imagine, because it probably depends in which country you land in as to what the rules and regulations are. So yeah, definitely, it probably is quite a lot of other businesses as well that face all of this double tax and international different tax rates quite a lot. Okay, over the next page, we've got a little section on types of foreign tax. So if you do pay tax and you are kind of trading overseas and paying tax to maybe Germany, there's two different types of tax you need an awareness of. You don't need to be able to calculate them. It says that at the bottom. You're not assessed on the calculations anymore. You just need to know what they are. So let's say we're trading and doing some sales in Germany. One of the ways that they may tax us is something called withholding tax. This is also commonly known as border tax, if anybody's heard that. And basically, this is because if you make all your money in Germany, you're selling lots and lots of products in Germany, you're using German labour to create some goods and you're selling the goods to German people, then at the end of the year, what could happen is that overseas business, all the profits they make, they might just pay it all back over to the UK business in a dividend payment. Now, the German economy aren't going to be very happy about that because you've earned that money in Germany, you've used German resources to make those sales and make those goods, but then you might send all your money back home through a dividend payment. So really, they would have liked to have reinvested it back in the local economy. So when you send that dividend back home, what they might do is at the border, which is why it's called border tax, they might withhold some of the money as a form of taxation and say, hang on a minute, you've earned this money in Germany, so even though you're trying to pay that dividend back home, we're going to withhold some of that money to reinvest in our local economy because that's where you made the sales, that's where you created the goods. So that's what we mean by withholding tax. It's withheld at the border. The other type of tax that you might see for overseas is underlying tax. And this is basically the same thing as kind of corporation tax, but it's overseas. And this is the idea that if you make money overseas, you might have to pay corporation tax on any profits you make, similar to what we would do if we make money in the UK. And so they've just said here, if a company then pays a dividend, they will be paying that dividend out of a post-tax profit because it's already been subject to overseas corporation tax. And therefore, the profit that's distributed as a dividend will have already suffered tax on that profit. So that's as much as you need to know for types of foreign tax. Underlying tax is like corporation tax but overseas. Withholding tax is an extra tax they take at the border if you try and send money back home via maybe a dividend payment. Okay, I think there is now just a little bit to bring us to the end of this chapter on corporate residency, and then we've got a bit on transfer pricing. But corporate residency, we've already looked at a little bit at the start of this chapter. We said someone is a resident where they are either centrally managed and controlled or incorporated. And we did that funny example, which was like a riddle of where are they centrally managed and controlled, where are they incorporated. But I said it creates a bit of an issue if maybe you're incorporated in one, centrally managed and controlled in the other. So if that's the case, to try and establish where actually are they a resident, you can apply something called the OECD model. And that says that you usually are a resident where you have a permanent establishment. Now, a permanent establishment could be a factory, a workshop, an office, branch, place of management, mine, oil or gas well or place of natural resource, or a construction project or building site if it lasts more than 12 months. Now, it's a bit annoying, but you just need to learn those. I have seen a couple of multiple choice questions before where they've said which of the following would constitute a permanent establishment. When I've seen it come up in exams, they've done things before and said like, oh, a construction project for 6 months. And that wouldn't be a permanent establishment because it's got to be for more than 12 months. So just be aware of what those factors are. Now, if you're still not sure where they are a resident, if it's still a bit of a grey area and you're not entirely convinced, then we would say the overriding factor is that an entity is resident in the country where it is effectively managed. And effective management, that means where are the day-to-day decisions being made? The people who are calling the shots and making the day-to-day things happen, where are they based? And that is our overriding factor if you're still kind of not sure where a country is a resident. Okay, any questions on that so far? So we've just got one last bit in this chapter, which is on transfer pricing. Now, transfer pricing, this is something that applies mainly to groups, and it's where you mainly sell goods between the group. So the parent and the subsidiaries, or the subsidiaries themselves trade with one another, or maybe they give loans to each other at favourable rates. Now, the easiest way to explain this is to show you an example first, and then I'll go through the notes to show you how this aligns. So you don't have to write this down if you don't want, it's completely up to you. But let's say we have a parent company. And within that parent, we've got two subsidiaries. Let's say we've got over here, the blue one. This is my little factory. And this is company A. And then over on the other side, we'll have my purple factory. And we'll say that the parent owns this one, which is company B. Now, company A, we'll say, is a UK business, whereas company B, we'll say, is an overseas business. In the UK, back in company A, we know that corporation tax is about 20%. However, overseas, company B, let's say corporation tax is 2%. So if you were the parent at the top, which business would you prefer to have your profits in? Out of company A and company B, which one would you prefer to have the bigger profit? Yes, absolutely. You'd want your profits to be sat over here in company B. And the reason being is because if you manage to achieve that, you will only pay tax at 2%. So the parent company knows that. So what that might try and do from the group perspective is they might try and manipulate their accounts to get the profits sat in company B rather than company A, because then they can pay a lower rate of tax. And ways that they can manipulate that to happen is through transfer pricing. So to give you an example, what could happen is maybe company B sells company A some goods. We'll use a really silly example. Let's say they've sold something like a pencil. So they sell a pencil which is worth £1, but they sell it for £100. So company A buys a pencil for £100 even though it's actually worth £1. And we're not talking Apple pencils here, we're talking about a HP lead pencil. So in this scenario, that means that company B have made a £99 profit. That £99 profit is going to be subject to 2% taxation. As opposed to company A, who have now got a £100 expense, normal business expenses, they're tax allowable. And that means in company A, they're going to have a tax saving of 20% of that. So they'll be tax saving £20. That's a tax allowable deduction. So you can see here, this has worked out really well because the profits have only been taxed at 2%, and they've also managed to get a massive tax saving in the UK of 20 quid. So this is what I would call transfer pricing manipulation. Now, obviously governments know, local companies or countries know that groups will try and do this when they have more than one subsidiary and they have overseas subsidiaries. So because of that, there are usually a number of rules for transfer pricing. So they've mentioned a couple of bits here. They've said sometimes transactions don't take place at an arm's length basis. Arm's length basically means at market value, such as my pencil being sold for £100. They may do this in an attempt to avoid tax, like I've just mentioned, so there is some rules that countries usually implement. So for goods and services, which is what I've just demonstrated, an adjustment is usually made in the corporate tax computation for the entity that has gained the tax advantage, and they will make an adjustment to say what would the profit have been if the transaction had been at an arm's length basis. So actually, if you'd have sold that pencil for maybe £2, which is what it's worth, instead of £100, what would your profit have been? And they make an adjustment in their tax computation for that. So basically, they get rid of any of that unfair advantage that they've created for themselves. Now, the same thing happens with finance. I'm not going to do a whole example again, but basically, company A and company B could give a loan to each other and they could charge a really stupid interest rate. They could charge like a really high interest rate to shift their profits, because it means the finance cost in one business is going to be really high and the investment income in the other business is going to be quite high. So they can manipulate profits that way. So if you have provision of loan finance within a group, they say if the amount provided exceeds the amount a third party would be willing to provide, then it's not at arm's length. This is what we usually call thin capitalisation, and an adjustment is made. And any interest that's charged on this excess is not allowable for tax purposes. So it would be classed as a disallowable expense. You wouldn't be allowed to have that as a tax allowable deduction. Okay, so that is our international taxation ticked off. Any questions with any of that or the transfer pricing stuff? No? Okay, so the next chapter, chapter 4, that's one that is set for homework. Now, it's a really quick, easy read chapter. You basically just have a little read through it. It talks about regulatory environments, but we're moving away from tax now. This is more kind of getting into the accounting waters. Tax is now finished. Tax was the 20%. We've finished that. It's the first 3 chapters. We're now looking at the next 10% of the exam. So chapters 4, 5, and 6 forms 10%. So you can have a little read of the regulatory environment, and it's about regulation around kind of accounting and finance, where the rules come from, a little bit of that. And then we're going to have a look after break at ethics. So we'll do chapter 5 and 6 after break. It'll take us up to the end of the day. So what time are we on now? We're at 7 minutes past. So let's say a break until 20 past, if that's okay with everybody. And I'll see you all in around 13 minutes. Oh, got some questions. I didn't see those in the chat. How is transfer pricing examined? Yeah, so in terms of it being examined, you just need an awareness to know that if there is a parent and subsidiaries within a group trading with each other, then if it is not at an arm's length basis, then an adjustment is made in the accounts. And then it's the same with loan finance. If it is thinly capitalised, which means you've given more loan than what a normal bank would, then any interest on that loan is disallowable. And that's all you need to know. So it might come up in a multiple choice question, true or false question, something along those lines. How do they decide on the correct price for a product? Yeah, so the arm's length basis, the arm's length price, is just what is the going market rate. So you could look on, if it's something that's widely traded, if there's an active market, you could look on sales sites, resale sites, eBay, whatever it is, sales platforms, brochures of suppliers to see what is the going rate for that item. Does it matter where the parent company is based? No, so it's all the transfer pricing means is that if you are trying to manipulate profits across borders because you have subsidiaries or parents in different countries, then rules will come in place to make sure you're not gaining a tax advantage from it. So if there's any more questions, let me know. Pricing is based on the country where it is sold or purchased. So it kind of depends a little bit on if it's like a branch or a subsidiary, but if it's something like a subsidiary, then yes, it's based on wherever it was sold or purchased, whatever that country is kind of trading in or operating in. Will the government be liable to find that information of the company? The company would have to disclose when they create their financial accounts that obviously they have overseas subsidiaries, and they have to make a disclosure for any, they're called related party transactions, which means they've bought or sold goods from a related party, such as a subsidiary is a related party. So the company would have to disclose that and make the appropriate adjustments. And then it'd be the auditors who check the financial accounts to make sure that all those related party disclosures have been made and adjustments have been made as well. And then if the auditors think, yeah, it's all been made, it's all looking good, then they'll issue a report, an audit report that says the financial statements are true and fair. So it's the company and the auditors. Hello everybody, welcome back for the last session of the day. So if you could turn to chapter 5 for me, please. We're going to have a look at that. So as I mentioned, chapter 4 is going to be for homework. It's nothing too big. You'll get through that in less than half an hour, to be honest, but you can use the study module to help if you want. So we'll have a quick chat through chapter 5, a bit on ethics. So ethics, we need to know kind of two things with ethics, mainly looking at the why ethics are important, and then also what the ethical code is. So ethics, we have a code of ethics. Sometimes it's called the SEMA code of ethics, but it means the same thing. Any ideas of what goes into that code of ethics? Any takers? It's been in other exams, if you've taken any of your other exams. Yeah, absolutely. Integrity. So as professional accountants, we should be acting with integrity, which means straightforward and honest. Yep, objectivity. We should be being objective, which means we are acting without any form of bias. What else have we got? Professional competency and due care. Yep, absolutely. So professional competency and due care. So that means we should make sure that we are upkeeping our professional skills, which is what you guys are kind of doing now, getting qualified. Then when you are qualified, you should do some continual professional development. What else have we got? We have got confidentiality in there. Yep, absolutely. So even after relationships end with clients, we should still have a level of confidentiality. And yeah, absolutely, that last one in there, professional behaviour. So we should act in a law-abiding citizen way, professionally. We shouldn't do anything that could discredit the profession. So as Kimberly's mentioned there's a few mnemonics you could use to remember this. You've got POPIC, you've got loads, you've got PIPCO, some people remember that. You've got OPIC, some people prefer that. Kimberly there, POPIC as well. They're all the same thing, but they're our code of ethics. And it just stands for the first letter of every one of these 5 things. So that's the main thing we're going to focus on in this chapter, what that means, what the threats to those could be as well. But if we go down to the first page, it kind of talks about why we care about ethics. Why is ethics so important? Now, the biggest thing is that as accountants, we are in a position of trust. Accountants, auditors, whatever in the finance world, we're usually involved in the preparation of financial statements. Financial statements, they're used by shareholders to basically decide whether to invest more or less in a business, to make decisions. So if people are relying on those financial statements, we need to make sure that when we're preparing them or when we have a say in creating them, that we are acting fairly, honestly, and in a responsible manner, because we're in a position of responsibility. They've said just here it's very essential because it's how accountants perform their work. When we're preparing financial statements, we're in a position of trust. People are going to rely on our accounts. So loads of mnemonics to remember it. You guys have already gone through a couple of these with me. OPIC is the one the book mentions, and it says if that you can't remember OPIC, you could remember over, pompous people ignore codes, which also spells OPIC. And you've got your kind of 5 elements here. So we've mentioned these already. Objectivity, making sure you are acting without bias, without conflicts of interest, without influence from other people. Professional competency and due care, making sure you've got knowledge and skills. Professional behaviour, making sure you are not acting in a way that could negatively affect the profession. Integrity, being straightforward and honest. And confidentiality, acting in a confidential nature. So you're not exposing facts to other people that they could use for personal gain. So just a little quick one, example below, pop your answers into the chat panel, 1, 2, 3 or 4. Mumpta thinks it's appropriate to take a sickie when she wants a day off. Which of the principles do we think is at stake there? Yeah, absolutely. Lots of people going for 1, integrity. And that's because integrity is about being straightforward and honest. And getting yourself a little bit of a sickie because you want a day off is obviously not being honest. Now, as accountants, we would love to act in line with these 5 principles, but sometimes there's things going on in our environment that prevent us from acting with these 5 principles, and that is what we would call our ethical threats. So over on the next page, we've got a little bit of a write-up about what are the ethical threats. Now, they have come up this time with the mnemonic of CIFAS. They've also said, if you prefer words to remember, study in depth for accountancy success. A bit cheesy, but there you go. And what that stands for is each of these threats below. So SIFAS spells out CIFAS, and that is your self-interest, intimidation, familiarity, advocacy, and self-review. So if you have a self-interest threat, what that means is that something is in it for you. So maybe you're not acting in a neutral way, because if you act in a particular way, then you get some sort of benefit. So it might be like, as an accountant, maybe my manager's come up to me and said, oh, Gemma, if you could just authorise this expense, even though I know maybe it's fake or it's not a real expense, if you authorise this, then I'll put you forward for this promotion that's going on at the moment. You see, I might then think, oh, even though this expense is fake, I'm going to authorise it because then I have the chance of getting a promotion. Something's in it for me. Maybe I've got some sort of incentive to act a particular way, which is against the ethical code. Intimidation is the next one. And this is when, it kind of says it on the tin, you're a little bit scared to say anything bad. And that might be because you are being threatened, you are being intimidated. So it might be someone at the office has come up to me and said, Gemma, you need to approve this fraudulent expense. I know it doesn't really exist, but you need to approve this fraudulent expense. Otherwise, I'm going to make you redundant and you're not going to have your job anymore. So even though, as an accountant, I should be acting in an unbiased way with objectivity, I might feel pressurised to act against that ethical code because I'm being intimidated or threatened. Familiarity is another thing which could threaten our ethical code. And this is where you just become a little bit too closely aligned or too friendly with others. And if you become a little bit too friendly with others, you might not necessarily want to do something that could compromise that relationship that you have with that person. So I'll pop in here. So don't want to do anything to upset them. So for example, maybe I'm an auditor. I've been auditing this client's accounts for years and years and years. We've got a really close relationship, and I don't want to highlight anything bad in their business or anything that looks a bit dodgy, because I'm worried that then they might not pick me as their auditor next year, or it might damage the relationship that I've built with them. So I'm not acting in line with my ethical code because of the threat of upsetting someone. I don't want to upset a relationship. The next one is advocacy. So with advocacy, this is when you spend quite a lot of time with somebody that your views become quite closely aligned to management. So your views closely aligned to management. And what that means is you kind of lose a sense of objectivity. You lose a sense of having your own personal opinions, because it's almost like you've been brainwashed by somebody else because you've spent so much time with them that your views have just become really, really similar. And then the last one is the self-review threat as well. And the self-review threat is simply, if you are reviewing your own work, you are unlikely to spot mistakes in your own work. So you shouldn't be doing a self-review. You should be getting somebody else to review your work. So I'll just pop in a little few points here and say, if you are reviewing your own work, then you are unlikely to spot mistakes. Because if you knew it was a mistake, you probably wouldn't have done it in the first place. So that could threaten the 5 ethical principles. If you're reviewing something yourself, it could threaten your objectivity because you're not going to be acting objectively because you've done it yourself. So you're going to think, oh, well, it's right because I've done it. So they're the threats that could get in the way of our 5 principles. So over the next page, we've got example number 2. Have a little read through, pop into the chat panel which you think is the correct option. Okay, getting quite a lot of people going for number 2. Yeah, intimidation. So I'm going to go with that one as well, because it sounds like it's being really, really intimidating. We've got a manager's bonus. They're saying it's going to be affected. The key word there is that pressurized point, which just looks a little bit like I'm being intimidated. Okay, so if we have a look at the next bit, that is what happens when you find yourself in an ethical dilemma. How are you going to resolve it? Now, this is like a rank starting off with kind of really mild steps to resolving an ethical conflict, going up to kind of the most severe step. And the way you follow it, it's a bit like a snake. So this one is the first point here, and then it goes down. If you follow the arrows, it goes across, then up, then across, then down. It's a bit weird the way they've kind of laid it out. So step number 1 is you might check all your facts and documents. So if you think maybe someone is being intimidating, maybe just check the facts, maybe speak to somebody else about it as well. Consider next, is it ethical? Have you considered the ethical issues involved? So here you might want to think, are any of your ethical principles being threatened? Is there any threats? Then you might want to think, is it legal what they're doing? You might want to identify some of the principles that are being threatened. So this is where you're thinking of that OPIC or PIPCO, whichever one you prefer. You then would think, well, who is affected? Who is being impacted by this? And then you might look for possible courses of action, so internal or external escalation. Now, this is where we really start to step it up, because if we're still in an ethical dilemma, we might then start to seek professional or legal advice. And then the last kind of point at the end is if we can't resolve the conflict, then we would have to refuse to be associated with the client anymore. But that is really kind of the last step. You don't want to kind of hand your notice in or drop a client if you can help it. You want to try and remediate the problem first. So a little bit of a question to pop this kind of flow chart into practice. Have a read of example 3, and then 1, 2, 3 or 4, pop into the chat panel. What would you do? Hey, lots of people going for 4 there. Yeah, I do that too. Probably speak internally to your supervisor. If that's not going very well, maybe then go to the senior management. If that's not going very well, maybe speak to the professional body or inform the auditors. So kind of start internally and then go externally. And yeah, it does depend where the issue is as well. It's not given us much to go off in this question, has it? We've got a little bit of a question on the next page. Shouldn't take more than a couple of seconds. Tick whether something is a principle or a threat. So you might want to think of that OPIC and CIFAS mnemonic for this one. Okay, so it shouldn't have taken us too long with this one. We can think of our ethical threats, which is that CIFAS mnemonic, or our principles, which is OPIT. So advocacy, that's going to be threats. Confidentiality and integrity are principles, and then the bottom two are both threats as well. And the last one, have a go at example 5. And when you get an answer for example 5, if you want to pop 1, 2, 3, or 4 into the chat panel for me, please. Okay, getting a couple of answers coming through into the chat panel. Looks like most of us are all going for 1. I would agree there as well. Unethical behaviour, delaying payments despite repeat reminders to pay. That's not really acting with much professional behaviour. Okay, fab. So that's it for ethics. The main things there being the OPIC, which is your ethical principles, and then CIFAS, which is your ethical threats. And you might get a couple of questions around identifying them in the exam. Great stuff. Any questions on ethics before we move on to the last chapter? If you've done any other exams before, then you've probably seen all this ethics stuff in the past, which is why I'm not spending too long on it, especially if you've done any of the other kind of level 1 papers. Okay, so last chapter for the day then. I know we've done quite a lot already. Your brains are probably starting to get a bit saturated. But the last one is on corporate governance. So corporate governance is basically the system by which companies are directed and controlled. And when you're thinking about the direction or control of a business, there's lots of different ways that you could do that. You could take kind of a very authoritarian approach. You could take a little bit more of a hands-off, laid-back approach. There's lots of different ways of doing it. And that's what we think about corporate governance. It's how do you govern, how do you control and manage the corporation? So if we go onto the first page, they've just explained what is corporate governance. How are you directed? How are you controlled? And the main aim of corporate governance is to ensure that businesses run effectively and in the best interest of their shareholders and wider stakeholders. So when thinking about corporate governance, you need to be thinking about what's the responsibility of the directors in the business. What would be an appropriate composition for the board of directors? So we have something called like executive and non-executive directors. Executive directors are people who have an active kind of stake in the business, whereas non-executives are more people who have an advisory role. So when you're thinking about your board, it's quite good to have like a mix between executive and non-executive directors just to provide balance. A lot of the board, we want to make sure we're striking balance so that there's not one overarching person making all the decisions and calling all the shots, because we should have other opinions to balance things out. Corporate governance is also really important for a system of internal controls. Corporate governance, it says you should have an audit committee and you should have good relationships with your external auditors as well. So it kind of covers all of those bits and bobs. Now, the biggest bit about corporate governance is the approach, and you can take a couple of approaches. You could take what we call a rules-based approach or a principles-based approach. Now, they've got examples on the next page, but before we go there, I just want to draw up a little bit of an example with you about something. You definitely don't need to draw this out, but let's say I've got a motorway and I've got lots of cars on this motorway, and let's say that the speed limit on my motorway is 70 miles per hour. So if you were driving on this motorway today, it's a nice, dry, sunny day, would you drive at 70 miles per hour? Yes or no? Don't overthink the question. It's not a trick question. Okay, so maybe some of us driving a little bit more than that. Yeah, some of us might speed slightly. 10% leeway, yeah. I mean, it depends how much of a rush we're in, I guess. But most of us would probably drive at 70 miles per hour. And the reason being as to why we would drive at 70 miles per hour is because the law says so. It says we're allowed to drive at 70, so that's what I'm going to do. Now, let's take another day. Let's assume it's now December. It's not a nice sunny April day. And in this horrible December day, it's raining, as it tends to do most of the winter in the UK. So we've now got a little bit of rain going on my motorway. Maybe it's a little bit foggy. It's a really foggy day. And maybe there's like really big bits of black ice on the motorway as well. Now, if that's my day in December, would you now drive at 70 miles per hour? You'd stay in bed. Yeah, I probably would too. But no, you wouldn't drive at 70 miles per hour. This time, you're probably going to drive at about 30, 40 miles per hour. You're probably going to half that speed limit. Now, the thing is there, all of you guys have just used your intuition. You've used your common sense and thought, even though the law says I can drive at 70 miles per hour, you're not going to because of the conditions of the road. So that is what we mean by a rules-based system or kind of a principles-based approach. What a rules-based approach would say is it's very black and white. The speed limit's 70, so you're going to drive at 70 miles per hour. It's a really strict kind of code and law that is written out. It's very black and white. It's very rules-based. However, a principles-based approach is where instead of just following the law, you follow the spirit rather than the letter of the law. So this time, this is like you slow down because there's ice or there's fog on the road. So that's the difference between a rules-based and principles-based. Principle-based, you're following the guidance and using it as a base and then making your own intuition, as opposed to rule, which is right or it's wrong. So when we're thinking about corporate governance, we can have the same idea. We could have a rules-based approach to really strict rules which we must follow in terms of governing a business or governing a country, for example, in the US. And they've got really strict laws like Sarbanes-Oxley Act, which is came into play after the financial crisis. It's basically just more disclosures on audits. Or you could have a principles-based approach, where you've got the law, but then you should apply that and apply some common sense to it as well to enact the spirit, not just the letter of it. So there's benefits and disadvantages of both of them. A rules-based approach is that it's really, really easy to follow. Everyone knows what's expected of them. But the disadvantages of that is that it probably needs updating quite frequently. And also, it's the kind of age-old rule that if it's not written down, then it's not a law. So that means that it could encourage some loopholes as well. As opposed to a principles-based approach, whereas this one is probably going to prevent exploitations of loopholes. Because even if something isn't enshrined within a law, you would use your intuition, you'd use your common sense, you'd use your spirit of the law to think, actually, that's not right, I shouldn't do that. Also, kind of another advantage is it means principles-based approaches are quite flexible, especially if it's rapidly changing environments. But the disadvantages of this is that it encourages judgments. Because obviously it's not as black and white, so it's a little bit more of a grey area. So when you're thinking of corporate governance, you could pick either one of these approaches, and we've spoke about those a little bit. The next bit just says choice of a corporate governance approach. When you're picking between maybe a rules-based or a principles-based approach, There's lots of different factors that can drive that decision and contribute to that. Maybe dominant ownership structure. So who owns the business? Is it like a family-owned business? Is there multiple shareholders? Is it a listed business where you've got kind of like massive amounts of international shareholders? Or is it a really small business where it's just family and friends who are owners? That could really impact the approach that you take to corporate governance. The legal system, that could impact it as well. The government, and how is your government structured, and the policies in your government. So we've got examples up here that the US is a little bit more rules-based, the UK is a little bit more principles-based. That could therefore impact the corporate governance of UK or US businesses just because of kind of unconscious bias. The state of the economy, culture, history, capital inflow, investments, global economic and political climate, that can all impact which approach you take to corporate governance. So you can have a little go on the next page if you wanted to for homework. I'm not going to waste time on that one today. It's just a little tick box as to which one you think is better, rules or principles. And instead I want to just focus next on this corporate governance code. Now, the UK Corporate Governance Code is a principles-based approach. And essentially, it's a code, so things like recommendations, practices, best practice for businesses that are operating in the UK. It says that for most businesses, it's kind of critical best practice, especially if you are a listed business. So you should try and follow it. But as I've just explained, it's not a rigid set of rules. It's more about principles that you should follow. And the things that it covers is it looks at the leadership of the board and what a company purpose needs to be. It looks at division of responsibilities. So who should be the chair of the business or chair of the board? Who should be non-executive directors? What should the balance between executive and non-executive be? That kind of stuff. It looks at audit risk and internal controls. It looks at composition of a business, so how many people it should make up. Succession, so kind of promotion opportunities and who should have experience at what. Evaluation, and a little bit in there about remuneration as well, which is all about pay and making sure there's clear pay details and pay structures for kind of high-flying directors and lower level staff. So corporate governance code covers loads and loads of different things. It's absolutely huge if you ever actually read into the corporate governance code. So we're just going to scratch the surface of a couple of the things in the corporate governance code. One of the things in the corporate governance code is around segregation of roles. More commonly, this is referred to as segregation of duties, which means that everybody in the business should be responsible for kind of different elements. There shouldn't be one person who kind of does everything, because otherwise that could mean it's overpowering and dominating by one individual's preferences. So best practice in the corporate governance code says that whoever is the chairman or the chair's people should be separate from the chief executive officer. So the chief executive officer, the CEO, should never ever be the same person as the chairman. Not now, not at the same time, not ever. So if you've been a chairman, you shouldn't be a CEO. If you've been a CEO, you shouldn't be a chairman. They shouldn't be the same people. We've also got, in terms of committees, there's lots of different committees that are recommended in the corporate governance code. They recommend to have an audit committee. Now, your audit committee is basically a group of individuals in the business who might look at things like internal audit. So how are we doing internally with looking at our financial statements, our controls, are our financial statements looking true and fair? Audit committee also negotiate with external auditors to kind of appoint them, see who's going to be best for the job. And the UK Corporate Governance Code says that the audit committee should be 100% non-executive directors. So non-executive directors mean they don't have an active role in the business, they're more an advisory person. So that's your audit committee. You also have in your corporate governance code the remuneration committee, and they say again the remuneration committee should be 100% non-executive directors. I think that's pretty self-explanatory. Why? Remuneration is your pay, and if that committee who decided who gets paid what when they get paid, if that was made up of full working directors, executive directors who are running the business, then they'll probably just pay themselves a load of money. You've got the risk committee as well. They say that should be both executive and non-executive. And nominations committee, that's all about kind of who gets promotions, who should be nominated to be the CEO or the chairman or the vice president. The people on that board should be a mix of both executive and non-executive. And then the last one at the bottom is just around internal audit. And the Corporate Governance Code suggests that we should have a good level of internal audit. And what that department does is they do conduct a couple of audit procedures, mainly for internal use to see what our controls are like, but they have a massive responsibility for designing, implementing, and monitoring internal controls. So an internal control is something that a business does to make sure everything runs smoothly. So an internal control could be that any purchases over £100 have to be authorised by a manager, for example. That is a control to make sure that not any old staff member can go ahead making purchases that are high value. So what the internal audit team would do is they design that control, they implement that control, and then they monitor it, and they might do some sampling and check that any purchases over £100 have actually been authorised by a manager. Okay, so just a little bit in that chapter then about corporate governance, the rules-based versus the principles-based approach, and then kind of three main points there around the UK Corporate Governance Code and what is kind of best practice or recommended for businesses in the UK. Any questions on chapter 6? I know we've kind of finished things off with a bit of a boring, wordy chapter there, but at least it's ticked off, it's done. It's not a big one. And we've done the ethics, corporate governance, which is 10% of your exam. If you squeeze in chapter 4 as well, chapter 4, 5 and 6 is your 10%. Okie dokie. Do we need to know things like the agency problem for this exam? So by the agency problem, I assume you mean the kind of ownership of control problem, where we have stewardship and the fact that you're responsible for the resources of the organisation. If that's what you mean, then no. Yeah, so no, not really. You might just need to be aware what stewardship means, which is that your kind of managers or directors are in a best place, or they should be protecting the resources of the business and using the resources for kind of long-term growth and development and profits. But no, you don't need to know things like the divorce of ownership of control and the agency problem. All right then, so let's have a look then at homework, bits and bobs for you to do for homework. So there is a couple of knowledge checks to have a go at. There's a knowledge check called Principles of Tax, which covers chapter 1, 2 and 3. And then in terms of chapters for homework, you've just got chapter 4 to do. We managed to do chapter 5 and 6 in class, which is good, so I can scribble them off. And then when you've done chapter 4, you can then have a go at the knowledge check for the regulatory environment, which covers chapter 4, 5 and 6. So you can do them at your own leisure. They're not really kind of difficult, kind of hard, big, long tests. They're just more like little quizzes to check what you've learned, if you've taken anything away from today, and see that you're on track. So I do really recommend doing them. But chapter 4 as well, you need to do that before you can do the second knowledge check. So we have actually got through the content kind of a couple of minutes early. So I will stick around. If anyone has questions, please do ask away. I'm not going to keep you any longer than I need to. So I'm happy for you guys to drop off, maybe use a bit of this spare time to kind of have a read over chapter 4, which is the one that I've set for home study. So you can have a look at that if you want to in the next half an hour or so. But I'm here to ask any questions if you want. Thanks, everybody. I will see you all for your next lesson. Enjoy the sunshine, and I'll see you in a couple of weeks.